We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/PalisadesRadio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, as well as Odyssey if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
Should be excellent. And Steve, I really appreciate you setting this up. You were very instrumental in the idea, but also getting in touch with Phil. So I really appreciate that, Steve.
Tom, thanks. Yeah, I've been following Philip Newman. He was at GFMS and then did the metals focus, and they put out some very good data and information about the precious metals, gold, silver, as well as platinum and palladium. And I happen to like their world silver surveys, the gold focus. They put out very good information. So I'm glad that he's here explaining how they arrive at their data and to share some of the information that's happening currently.
Well, I think,
absolutely.
Yeah, I think Stevie just dated me by putting me back in my GFMS days. Not quite sure I really appreciate that, but no, you're absolutely right. In fact, I started out at what was Goldfields Mineral Services back in the 90s before it became GFMS. And then, as you said, eventually transitioned to be one of the partners in Metals Focus, which actually celebrates its first decade next year. But I'll come to that in a little while when we dig a bit deeper into the company and the data. And as you said, some of the key trends, which I guess is perhaps one of the most important things as well.
Phil, why don't you give us a little bit of your background, if you wouldn't mind, while we wait for Tavi.
Absolutely. Well, I guess to cut a long story short, I have been an analyst my entire professional life. When I joined what was Goldfields Mineral Services back in 94. I mean, at that time it was focused, I guess, gold and silver. And then I joined them as a junior analyst. If I'm honest, back then I didn't know much about gold because my background at college was in energy and oil economics. That was the strength of the college I went to. So that was my background. So I guess that was also attractive, moving from that into gold. And then, moving from, it's been a boutique company from, as I said, from Goldfields Mineral Services through to the GFMS days. And then we were acquired by Thomson Reuters in 2011. And then, that was fine, but it didn't quite work out how some of us thought. I think really to do with Thomson Reuters, but then some of us left. And as I said, three of us started Metals Focus back in 2013. And really, without getting into it now, because we'll come to that during the podcast or during the discussion, really maintaining the principles of just getting out there, getting your hands dirty, meeting the trades. There's just no substitute for the face-to-face. So really, I've been doing that for, I think it's almost 30 years. I've lost track of the decades. But really, that's I guess followed me through the whole time, really.
Excellent. Thanks so much for filling us in a little bit more on that, Philip. Tavi just joined us. Welcome, Tavi. Thanks for making the time for us this afternoon here and joining us for the chat about silver.
Hi, Tom. How are you? Thanks for having me. Looking forward to this.
Always a pleasure to have you join us, Tavi. You guys are very data heavy as well, and that your charts have been shared thousands upon thousands of times around Twitter and the internet. So it's great to have you be a part of this conversation as well.
Yeah, I'm happy to add to this community of precious metals and commodities, and I think it's one of the most interesting investment opportunities I've seen in my career, and to me, as I like to say, to me, this is almost like we're back to the early mid-90s when before the tech bubble, very few experts in the markets that could really, discern good and bad investments into the technology space. And, while we all like to look at CapEx flows and capital flows in general, the labor flows are the most important ones because it's the lack of folks being able to really find new geologists that are capable of navigating the market, and it's creating so many inefficiencies in some parts of it. And so to me, it's mind blowing to be able to buy so many companies with probability of discoveries that are not being priced in accordingly in markets.
Excellent, Tavi. Well, again, thank you for making the time for us this afternoon here. So, Steve, is there a particular spot that you wanted to start with Philip?
Yeah, thanks, Tom. I think to all the listeners, I came up with a small group of questions I wanted to ask Philip about Metals Focus and how they get their information for the World Silver Survey. And I think a lot of the precious metal community gets its information from the World Silver Survey at the Silver Institute. But there's going to be like two parts of this. The first part's going to include Philip's information from Metals Focus, and then the second part later on, I'm going to discuss how I look at some of the different consultancies, which is a CPM group. Philip is not going to comment on any other consultancies' work, so I'm going to do some debate discussion about that, and then we're going to tie it in to how energy is going to impact the precious metal. So I wanted to start asking Philip a few questions that other people can also join in. And so I think the best way to start this, Philip, when the 2022 World Silver Survey came out, it showed a huge increase in physical bar and coin investment demand last year, 279 million ounces, according to what you all reported. Now, can you provide some detail on how you all arrived at these figures? And do you have a current update on the physical investment demand as for the forecast for this year, which you had for a little bit more? I think it was 280 million ounces. Could you talk about that?
Sure. So to deal with the first part, how we put the figures together, and if we focus on how we put together our investment, which there's a lot of similarities with how we do industrial or photography, jewelry, whatever it may be. And what we try to do is, bring together public and private information for the silver market, and really in keeping with most precious metals. Most of the information is private. Most of the companies we speak to are privately owned. And what we do as a company, we get out there and, we're meeting as many different companies across all different parts of the supply chain globally. So with Metals Focus, there's a team of about 30 of us in 8 countries. So where we don't have a physical presence, we travel there. So in the case of the US, we don't have someone based there yet, but quite a few of us, myself included, spend a lot of our time on the road meeting companies. And what we basically do is, it's quite an old-fashioned thing. We go there and we try to gain the trust of these people. And so even though Metals Focus is only, was entering like its 10th year almost, the fact I've been in the market since the 1990s, that is the same for a lot of my colleagues around the world. So not only do we have great contacts, but we have their trust, because they know that the next day, if you think about the main dealers in the US, be it the retail facing or wholesale, whether it's online, whatever it may be, they know that we're going to be speaking to their competitors. And so there has to be that leap of faith, that trust, that we would treat their information with the respect and the sensitivity it deserves. So when you read the World Silver Survey, it should be impossible for you to trace anything back to anyone that's been said by anyone. That's really quite important. Otherwise, this trust that we spent years building up, it disappears in the blink of an eye. So obviously there's a vested interest on our part as well. We want them to trust us to give us the best information, the best insights, which we then put in the Silver Institute Silver Survey. So that's the third thing. So we're meeting with the trade, understanding, some of them share figures, some of them don't, some of them share trends, but even those trends are really important to understand, market share changes. So, what's happening with coin versus bar ratios, what's happening within the 1 ounce versus 100 tens, whatever it may be, because you can't treat it as like a uniform creature. Bar demand rises. It simply, as everyone knows on this call, that's not how this works. So we're trying to bring together, the qualitative and the quantitative. One thing we do have, though, is a coin survey, and each quarter, Mellors Focus goes to the major mints, and on a confidential basis, they tell us where they sell the coins at wholesale regionally. Now, there are wrinkles with that because, a mint may sell them at wholesale in one country, that dealer turns around and ships them out. That mint won't have that insights. But what it does, though, it gives us a consistent series over many years that helps us to understand what's going on. And so, again, that comes back to that trust. The mints are giving us this data, and they know that we will treat it very sensitively. So that's really important. The other public data we have is trade data. And if you looked at the silver survey, we did spend some time talking about these flows of silver bullion out of Switzerland and out of Turkey, from Australia into the US. And what we did there is speak to the companies at source, the refiners in those markets, to get an idea, sometimes precise, sometimes not precise, let's be honest, what, say, the share of, say, 1,000 ounce was versus minted product, because 1,000 ounce isn't part of our retail investment series. So again, it's about always bring together those various sources of information. I think the other important thing to stress is that you always cross-reference information. So if one company tells us they're supplying X into the US, we then try to understand either from the counterparty in the States or someone else to validate that flow, which is incredibly important as well. So I think that gives you a flavor of how we put together sort of the coin and bar numbers. And as I said, we replicate that, what we're doing in the US, in other markets. So in terms of physical investment, coin and bar demand, there are pretty much 4 main markets. You have the US, you have India, Australia and Germany. And we have an office in Mumbai, so they're doing exactly the same thing there. That's an incredibly dynamic market, so it's even more important to get out into the market, because a couple of years ago, there was a lot of selling back into the market. And, we don't really get a lot of that in the States, but in India, it was really quite sizable. And so, we're going out there trying to understand what's going on, trying to understand what are the dynamics. In the US, in Australia, again, we're very blessed to have some very good contacts there who are willing to share. And in Germany, again, we know the main dealers, we know the main refiners, we know where the product's made, we know how it's being consumed.
If I could just interrupt for a second, are the companies that you're building these relationships with, are they producers, are they refineries, are they fabricators, or is it kind of all over the map, start to finish supply chain?
It really is start to finish to varying degrees. So we are speaking to the refiners that are making the product. We're speaking to, obviously, the mints, as you would expect, which again, obviously, is a fabricator, or at least is striking a blank. And then we're speaking to the dealers that are shipping it out. Now, it depends on the marketplace, because somewhere like the US, yes, you've got a small number of large wholesale dealers, but then beyond that, you've got an incredibly fragmented, nationwide retail distribution. We're not speaking to that level, I'll be honest with you. That's interesting and useful, but there has to be a line. And we find we get enough feedback from speaking to a combination of large B2C as well as the large, B2B as well.
How obscure is to find data from Chinese parties in general for the demand side?
So for China, we again are fortunate. We have an office in Shanghai. We have someone in Hong Kong, someone in Taiwan. So pre-COVID, when everyone could travel, we were out in the market. We know both the fabricators, because silver investment is very small from a physical point of view, not futures, but physical. It's not where the action's at. But you still got to speak to the banks to make sure that's true and to make sure that doesn't change. You don't just assume that's how it is and then carry on. If you know the Chinese market, you've got to have that official blessing. So we work with, the China Gold Association. We have very strong links in China. And it's very important that all of our work is translated into Chinese. We distribute it via, corporate WeChat. So we're very deep into the Chinese market. But I have to level with you. If, Metals Focus was, say, 3 years old or 4 years old and COVID had hit, would we have these strong relationships and be able to carry this on during COVID? I don't know, certainly not. So it's, we are very fortunate that we had, many years to put up these relationships. So when we couldn't travel, people understand when we contact them and they have that confidence to share content with us.
Do you see a market difference between Chinese investment demand over the last 2 years versus, let's say, U.S. and Western investment demand?
I mean, if you're taking a step back, because as I said, it's the silver demand there is very, very small. So it's not something that they are necessarily focused on. It is very heavily, in keeping with much of East Asia. It's very heavily, a low premium gold bar market. That's just how it is. There's just not much going on from that point of view, if I'm honest with you. So that, I think, is one of the key differences that we see. But as I said, it's about just staying in contact with that market, so that if things do change, then you're on top of it as well.
Hey, Philip, yeah, with that last question, again, you had mentioned that you reported about 278 million ounces of physical bar and coin last year, and that was supposed to maybe go up 1 million ounces. What are you seeing now about halfway throughout the year? I see the Silver Eagle demand has been less for various reasons. Is there any forecast that you could give on how that may be changing this year?
Yeah, but I think you raise a really interesting point. So when you say the US mint demand is less, are you, in a sense, basing that on what you see on their website? Is that fair?
Yes, that's fair.
Yeah, I think what we see, if we take a step back, I think the year has changed quite a lot already, and silver investment demand can be quite volatile. You only have to look back at some of our series that we went from 300 million ounces plus in 2015 and dropped by 100 in a year. And then it was pretty subdued before bursting into life over the past couple of years. So I think demand, last year post, when Reddit really kicked in, the Reddit squeeze, that's when things really burst into life. It was really interesting that, Jan last year wasn't that great for silver, but that all just turned completely when that all kicked off. And it just stayed so hot, as I'm sure many of you on the call on the cast will know. And I think some of the premiums we saw were exceptionally eye-watering. Dealers rationing stocks. I think that certainly is backed off now. We see premiums have come off quite heavily. We have to be careful. Sometimes as an analyst, I focus too much on the year-on-year or the month-to-month percentage delta. But I think just because things have quietened down, they quietened down to a hectic pace rather than being frenzied pace. So I think demand is still pretty decent in the US. But what we are doing, though, is I think paying a little less attention to the US mint figures, because I just don't think they're representative of what's happening in the US market. That's why it's so important to have our coin survey, where we can see maybe other mints doing perhaps a little bit better, where you can see the bar market doing better as well. And when I say the bar market, I'm including the 1 ounce rounds as well in that, which is obviously so important in the US. So I don't think the US mint this year is just not a proxy for US investment, if I'm honest. So that's why at this point in time, we are still sticking with our forecast. And our forecast, I think you were right on the money, Steve, with your numbers. It's about 290. We're still running with that versus about 279. But, so that may not look too exciting from a year-on-year point of view. But given that it was only in 2019 that we were 190 globally, and now we're 100 up that on that. So I think that's still a very strong position. I think there's a little bit more selling back. If you look at the ETF space, they're down about, I think, 5 or 6% year to date, thereabouts. So I think there is certainly a little bit of cooling, but at the same time, where prices are now, I think that just presents, quite a buying opportunity. So I think the market has burst into life, and it can be pretty volatile, much more so than, say, gold investment or even platinum.
Okay, Philip, thank you for that. And so, yes, I know the U.S. is probably, you would agree, the largest physical silver investor in the world. And of course, China and India tend to be the largest gold investors. What I wanted to ask you, when you all analyze the supply and data over the last several years or decade, and even currently, what segment would you say that the metals focus determines as the leading driver of the silver price, or let's say one or two, or the main drivers of, what do you think are the main drivers of price? What, from your analysis, what would you say?
Well, I think there's a couple of things I would really bring out from that. I think what we're seeing now is, I think it's very much about institutional play, because I remember even a couple of months ago when I presented the Silver Survey findings in New York, and people were looking at our price forecast, and we were calling for prices to soften, maybe not as much as now, if I'm honest with you. And people were saying, well, how can you have prices softening when you've got retail premiums in the US at eye-watering levels? You've got local New York versus London at consistently a premium, which is almost unheard of. And when you've got almost like shortages of 4 nines or sometimes 3 nines in Europe, for example, how do you square that circle? And I think very much it's because, institutional investors were looking at silver and concerned about, a recession coming. And so you've seen, base metals taking a bit of a hit. And because silver, as everyone knows on this, is, has that dual characteristic, it's taken a bit of a double hit. Gold is suffering because of interest rate expectations and because the dollar is a multi-decade high. And so that's hit silver. And then again, as I said just now, because half of global demand is industrial. And so even though underlying strength is there in silver demand, the coin and bar market is doing really well. The jewelry and silverware is recovering quite nicely, led by India. The industrial demand, we can touch on that, is having a pretty good year in spite of everything that we see overall. I think really the key driver is what's happening in the institutional space. I think the other thing, Steve, I'd pick out is, what the key fundamentals are doing. And I think that's more from a longer term point of view, because if you look at the Silver Survey, you can see over the history of the past 10 years or so, overall, the market's been in surplus. But now we think we've had a couple of years of deficit. We think we're going to get a pretty chunky one this year, maybe somewhere around 70 or 80 million ounces. But, that in its own right isn't that sizable when you've got a market of demand of 1 billion ounces. But when you've got a period of deficits year after year, then I think that slowly starts to change some of the dynamics. I don't think that will drive prices higher, but that doesn't mean it's not important. And I think what it will do is help to put a floor under the price. And I don't think we should underestimate, how important that is in the marketplace as well.
Philip, thank you. And I just have one more question, and then maybe some others if they have anything they want to add. I agree with you, and my analysis of the silver and gold market, and if you look at the World Gold Council, which I believe Metals Focus also provides the data for that, you'll see a chart where when the gold flows go into the gold ETFs, the price goes up, especially during the pandemic shutdown. And when you look at the months or quarters when we see gold net outflows of the ETFs. That's when the price goes down. It seems to be on a lesser extent for the silver ETFs, but I think I'm starting to understand there's two different markets. There's the professional institutional market that's driven by what the Fed and central banks are doing, correct? They wanted to get inflation under control. So the institutions are doing what they think by easing up on their gold and silver exposure, which a lot of them are in the ETFs. And so it does make sense. While you can have a tightness in the refining bullion market, you've got kind of the professional institutional market that's easing up, and they control a large part because we're seeing 30, 40 million ounces coming out of the top silver ETFs in just the past month. So I do agree with you. Do you have any more information you can shed on that?
I think that's a really good point that you make, though. So I think we certainly see really different drivers. I think a lot more stability in the silver ETF. I mean, those of you who were back in the market back in 2013, that was when when gold, fell out of bed, or rather prices fell out of bed. You had, big washouts in the gold ETF space, but silver barely moved. So you do have that stability. So I think what you do have is, to your point, is you have institutional investors really dominate the gold ETF space, whereas I think retail investors are far more prevalent in the silver. So I think that argues to your two speeds that you touched on. And to your point about the gold ETFs, the fact that you can see that link with the price, I certainly agree with that, because if you've got institutional investors dominating the gold space, then they're going to behave broadly, and I stress broadly, there'll be echoes of how they behave with, say, positioning on the CME. So you will have that link, hence you'll have that relationship that you just touched on in the gold market. And you certainly have them behaving with very different drivers as well. That's why you have the coin market behaving with the strength that we see, whereas institutional investors are liquidating their positions. So I think you certainly have these two speeds playing out, and that's why you don't have necessarily this correlation between what's happening in the silver ETFs with the price in the same way that you do with gold.
Okay, does anybody else have any questions? I mean, I've got just a couple more questions I want to ask Philip. I think, Philip, a lot of silver investors tend to be a little more frustrated because during the pandemic shutdown, you saw everyone move into the metals, and then gold hit a new high, over 2,000. But the thing we hear that silver barely touched 30. I think it barely touched 30. So exactly. I think one of the frustrations that silver investors, not gold, but silver investors have is, why didn't silver perform better, or at least, reach the same high it had in 2011 or 1979? Why did that not occur? And if that is going to occur in the future, if we are going to see 50 silver, what made the market conditions, the demand forces for that to occur?
Sure. Well, if we sort of touch on, the disappointment that you refer to, I think one of the key reasons is those fears, at the height of COVID, about what that meant from in terms of the economic prospects. So while gold had that flight from a safe haven as well, I think, investors for the silver market were taking a different view, because again, you had that weakness in some of the base metals. So I think although silver did relatively well, that's why you had the gold silver ratio picking up. And I think, I haven't looked at it, the past short while, but if you think about how the ratio has been recently in the high 80s and thereabouts, again, that I think is certainly reflecting those concerns about a recession. Because normally when we look at the silver price, whenever gold moves up sharply and silver, is a much more volatile metal, we tend to say that silver will outperform to the upside. Equally, when gold weakens, we tend to say that silver will underperform to the downside. So I think to your point, the fact that silver did disappoint, when gold hit those 2,000, we didn't see a great deal. And I guess the other point also, when investors, be it gold or silver, see perhaps a lack of reaction compared to what they were expecting, again, it becomes self-fulfilling. If this event didn't cause silver to behave as I expected to, then what does it take? Maybe I should be looking elsewhere. Maybe I should be shorting it. And as I said, it can become self-fulfilling. So there is, I think, an element of that. The next question about what would it take to get to $50 silver? Well, I think, unfortunately, you would probably need another black swan event. And without wishing to, what's the words? If we think about the Russia-Ukraine, without making light of that, because it is such a humanitarian crisis and the knock-on effect from inflation and so on. But even for gold, that, you saw this knee-jerk reaction. You do tend to find that when you have a war breaks out or one of these type of events, you often get this knee-jerk, but it can be relatively short-lived. You need something much more systemic, like the global financial crisis, I think, to really encourage investors to come in. But of course, you have to remember, you did have these almost like bubble conditions for silver and gold, just be honest, but especially for silver. And that's why you had this spike. But I think we have to be, if I could just say, we need to be careful what we wish for, because, from an industrial point of view, which is really the heartbeat of the manufacturing side of the market, a lot of industrialists, they remember $50 silver even now. And so they're still trying to thrift silver out of, not all, but a number of applications, because they don't want to go back there. When it gets towards $30, their sensitivity, it starts to really get heightened, let alone 35 or 40. If you were to see $50 silver and it holds there, or et cetera, it can cause demand destruction. If you're looking at $50 or $60 silver, you've got to have ongoing inflows into the market to sustain those prices. As soon as that stops, the price comes down. But when that investment disappears, you need to have the fabrication in there to provide some support. But if you've got these these record prices, then, as I said, it can cause demand destruction. So I think it's just something, if I could say, just to be mindful of, when we're thinking about, the price outlook.
Philip, thanks for adding that, because I almost forgot or didn't think about it, because that's true. When we had the pandemic shutdown, flight to safety is gold, and people were going to silver, but I just didn't think about it, or the light bulb didn't go off that you're shutting down the industry. And so even though you're getting a flight to safety, the investors are not moving into silver because they know certain amount, or because the industrial demand is really falling. And so I think that may have been the reason why it was underperforming gold. And I guess another thing we have to remember, the cryptos were doing very well, Bitcoin. So it seemed to be that the crypto space was attracting a lot of investment, where that may be weaning now. We may be seeing more people moving out of crypto and back into the metals.
Yeah, I think that's fair to a degree. I'm also a little skeptical about how much is diverted away from precious metals. Sure, there are those that are investing in precious metals from a speculative play, but I guess it depends if you're thinking about the retail space. I tend to think about retail investors, they're buying gold or silver for the qualities they bring, because they want to own the physical, because they're concerned about inflation in the country where they live, or maybe there's a mistrust of the government. These underlying core qualities. Whereas I tend to view the crypto space, perhaps someone on this will correct me if, will stand me corrected, but I think that's less about a hedge against inflation or as a safe haven. It's much more for the upside, for the speculative element of that investment. But I would also agree that, as that's faded, that should also favour the precious metals. But I still, as I said, I don't think they necessarily have, yes, the headlines have been there, but I think when you draw down into the numbers, I'm not entirely sure how much that's taken away. Because, for example, I've got colleagues that are going out into Indonesia and Thailand and Korea, and their crypto is a very big deal, a lot of buzz, but often it's from younger, and I don't want to date anyone on this call, but it's from younger investors. And so I'm not entirely sure if they would be natural to be buying gold or silver. They may want to trade the future, or they may want not crypto, but maybe their extension is an ETF, or maybe they want a digital product, which is going to be, say, physically backed. Yes, but I don't think that's necessarily harvesting or affecting the sort of the core coin bar market. But I'd be really happy and interested if someone on this has got a different view.
I have a question regarding the potential for, missing accuracy on supply data you guys provide, especially coming from private producers, companies that are not public. What do you think is your margin of error here when it comes to the supply numbers you guys put out?
On the silver specifically?
Yeah.
I got to say, I would say I still think we got a very low margin of error. We both track the producers, we track the trade flows, we speak to logistic companies, we speak to the refiners. At some point, we're going to capture that metal, wherever it may be. So I feel pretty confident. There's always a margin for error, and our figures do get revised. I've got to say less on the mine production, if I'm honest with you. It's more about on the recycling or even the industrial or the coin and bar as new information comes to light. It happens. But on the mining side, I feel quite confident. I think where we got a much greater margin of error mining-wise is for gold, when we're tracking the ASM, the artisanal small-scale mining. That is more difficult. But even then, we're looking at the flows and the refiners. So I think that goes back to my point in the beginning, that we try to look at it from all different angles, and hopefully that minimizes metal or the potential for lost metal.
And Philip, do you have any idea how miners have been affected with rising fuel costs, and how much that has actually affected their bottom line cost of production?
That's a good question. I don't have that in front of me, but I would say that some of their margins have been, you've got the double whammy of energy costs moving significantly higher, combined with case of silver coming under pressure. So I think that's something to watch out for. But I know in our latest figures that we put out there, we haven't downgraded our production, and in fact we believe that mine production will I think continue to rise. If I look at our global supply demand, we have it rising. So for example, our estimate, and it is an estimate or forecast, is about 844 million ounces for this year. And in a couple of years, we think that's going to just tiptoe above 900 million ounces.
Do you have any idea what percentage of that is from secondary sources versus primary silver sources?
If you're saying secondary as in
secondary as in
recycling
production.
Byproduct. Sorry, right.
Copper mines as a byproduct.
Okay, gotcha. Well, you've got, so roughly speaking, in terms of mine production, it's about 2/3 comes from base metals or gold. So you've got roughly about 1/3 that comes from primary, thereabouts. If we're thinking about the scrap, so the recycling, that is around the 180 million mark. And that's basically how you get to just over 1 billion ounces of global supply. But within the scrap, you've got a number of different routes of that, or streams. You've got the industrial, which is at end of life. Is that coming from the ethylene oxide changeouts? You've obviously got a little bit of jewellery, but mostly flatware within that category. And then although it's now, a shadow of what it used to be, 10, 20 years ago, you still get a little bit of photography. So those would be the main categories. But industrial scrap is the most important area of scrap supply.
Philip, I did have one more question from something you had said a little bit earlier about the younger Asian, that they're more into using ETFs or digital. Would you say the physical silver buyer tends to be older, or can you provide any information? Is there any way you know is the younger generation, some of them starting to wake up into buying physical? Or are they mostly using either ETFs or digital products?
I think this is probably, from my point of view, where it will get, pretty anecdotal. We haven't done, if I'm honest with you, anything that systematic. We look at it sometimes, by market. But I think that's absolutely right. I think for the younger investor, without wishing to make too much of a sweeping generalization, it's much more about, the ETF, the equity space that they are comfortable with. It's about the digital space, some of which may be physically backed. And again, that's much more towards gold than it is towards silver, but that certainly is coming, developing as well. But I think the next move from that will be, I would suggest, into the physical space. And I think it's really important that capturing, some of these younger investors in those vehicles where they're comfortable, and then they will either add to or transition. I think probably would add to in terms of the coin or bar space. As they, I was going to say mature. That sounds a bit patronising, but as they move through their career.
Philip, just two more. First of all, I think in the World Silver Survey that was released at the end of April, I think the average that you forecasted, of course, price is a fool's errand. You're trying to get price is difficult, but I know you put out a price of like $23.90, and now the annual price, not the current price, but the annual price is a little less than 23. Do you have any forecast on where you see the silver price ending as an average price by the end of the year?
Yeah, I think we have lowered our price forecast a little bit even since then. I think it's unfortunately at least in the short term are struggling. When you think about where the dollar is as a safe haven, I think there's this number of reasons. We look at expectations for what the Fed will do as well. Even if, the chances of a 100 basis point rise have been dialed back and it's now more, say around, the 75 basis points, that's still pretty aggressive. And so, given that concerns about a recession are pretty real, I think, this will persist, and I think this will continue to weigh on the metals. We do think that it will perhaps struggle to get a rate, higher than, say, the 24, 25 level. Maybe that can be even a bit of a push. But of course, it's a volatile metal. It can move $1 in a day, as everyone on this, on this discussion knows. But I do think that silver and gold, obviously it's been led by gold, but I think both will struggle this year and also into next.
All right, thank you. And the last question, I think there's this big debate, and you can answer this any way you'd like to. There's a big debate about how much silver above ground, if the price of silver moves up, and there's an idea that there's all this silver out there. And some gold analysts suggest that the reason why silver isn't such a good investment is that there's so much silver that could come back into the market as recycling. I disagree with that, but what is your insight about that question?
Yes. There's obviously, there's billions of ounces above ground stock. I think where we've got to be really careful is that, unlike gold, where the losses are trivial, you think about industrial products, even now, volume that's going to landfill. And we think about, for example, the likes of the photovoltaic market, which, is using around over 100 million ounces of silver a year. And only now are we potentially looking to recycle some of that. Now, of course, you can pull off a PV cell that's been installed for the past 10, 15 years to recycle. But there is a lot that has been lost, and a lot of that simply isn't going to come back quickly. Think about during the financial crisis when, people were queuing up to sell their silver. By and large, it was flatware rather than jewelry. Just the weight of the jewelry, the margins, it just doesn't make it likely. So you would need to have far higher prices to tease this out. So in other words, if silver moves from I don't know, from 20 to 25 to 30 to 35, even up to 40. Let's just play that. The amount of jewelry you're going to have coming out of the woodwork, I think is very low. It's very different from gold. You walk along 47th Street at the height of the financial crisis, you couldn't move along there. Now all the shops are empty and people are trying to pull you in. Yes, there's significant stocks. You've also got to think about, the more than 1 billion ounces of silver sitting in ETFs. We don't really view that as an overhang as it stands. We think that's a lot of stability in that metal. It doesn't necessarily say that if silver was to go to really surge, a lot of that, wouldn't suddenly be in the money. And so you could suddenly see some of that come out. But I just don't necessarily think it will come out that quickly. So I don't really think of that as necessarily as a reason why prices aren't higher or why they wouldn't move higher. I think it comes back to what I was saying in terms of those underlying key drivers. What are institutional investors watching? I don't think they're really watching above ground stocks of silver. A lot of that is hard to follow. You've obviously got the silver on COMEX, LBMA, and the Chinese exchanges. That's all very transparent, and we can see that. We also know how much of that is allocated. But just to give a really good example, Steve, if you go back to the beginning of the Reddit, when suddenly you had this jump in ETF holdings, which meant you had this jump in allocated silver in London, there were concerns about, what happens if this continues? What happens if we, not running out, let's just be clear, but running lower on unallocated? What's going to happen then? Yet, even with all that playing in the marketplace, silver didn't do a great deal. I think the above ground stock story, I would suggest, is a little less important from an investor point of view. And at the same time, if you look at our figures and you see, why would Metals Focus have the biggest deficit in their series of 80 million ounces this year, but prices are weakening? Well, that's because you've had a long period of surpluses. So it just takes time for that to have an effect as well.
And to your point, Philip, this would be interesting to see your perspective on this. I know I've asked this several times on the show, but sure. If we were to see starting to see a silver shortage develop, where do you think the easiest place or most likely place for that to manifest?
I think when you say manifest, you mean the silver coming out to support that? Is that what you mean?
Either silver coming out to support that, or where would we see that stress start to show for physical delivery? Would it be in 1,000-ounce lease rates? Where do you think we would start to see that tension occur?
Well, it's a really good question because we haven't really seen, as far as I can see, lease rates do a great deal. That's just my understanding anyway. But you look at the stress that you've had over the past couple of years. If you go back to, where are we now? 2020, where the EFP crisis, people scrambling to try and get silver into New York and all of, that was probably the height of it. That's when things got incredibly skewed. But even now, when fabricators or refiners are still struggling to some extent, mainly in, I would say, Western Europe and parts of the US, to get silver, it hasn't done much in terms of the prices or some of these other indicators, which I think is a really interesting one. I think if you did see, because, we see this, we've seen this quite a lot, haven't we, the past couple of years, where there's plenty of silver around. It's just not necessarily in the right form, in the right location. That's the biggest challenge. And I think, if you were to see in terms of the metal coming out to meet that shortfall, I think India will be a really interesting one. You've seen, eye-watering quantities. If I go to one of my spreadsheets and I just read out maybe a couple of figures for India. So between 2010 and 2019, Indian investors bought 500 million ounces of silver. 500 million. That's quite amazing. Then what you saw in 2020, it just fell off a cliff because they started to sell back. But even though they were selling back, the year ended with a tiny net positive, only 3 million ounces. But So there's a lot of silver that is in India alone that could potentially come back. And obviously, you know, when it's in bar form, it's low margin. It's obviously very near market. So I think that's the interesting one that I would watch, really. Yeah, that's you know, will we see, you know, some of these holdings that are very sticky start to come out? The amount of silver that that US investors have bought. If I look just at the bar market, which again, just to reiterate, includes the 1 ounce rounds, then again, they've also bought, you know, 500 million ounces over the past decade or so. And not much of that has come out. You know, we look at these figures, you know, I've been speaking to dealers, you know, all this year and last year saying, how much longer can this continue? How much longer can US investors keep buying this silver? And it still keeps happening. It's really quite incredible. But what would it take for some of that to start coming out? If we tend to think that demand is stronger when there's a Democrat in the White House, if we're honest. So if you were to get, you know, if the Republicans do really well in the midterms, which seems pretty likely, and then if people start thinking that you're going to have a Republican in the White House then building up for a couple of years, and you've got a lame duck Democrat government, administration, maybe that starts to see things weaken. And if prices stabilize, this is the other thing, just to point out, if prices were to stabilize, but you've got equities starting to strengthen, that's a really bad combination for investment in physical. So I think that is just something to be mindful of. You know, having a Republican administration, the view that they're, you know, whether it's right or wrong, are stronger on the economy. If inflation starts to come down, and then, as I say, you've got that price stability for silver, equities going to the races, then I think that's a really dangerous cocktail for silver investment, and then maybe by extension for the silver price as well.
If we look at your estimates for implied demand for silver in the years ahead, how much of that are you really looking at the demand coming from, potential demand coming from solar panels and so forth? What is that being part of your forecast right now?
Sure. Well, so we have that just in a very rough, you know, we think that the solar is about 20% of global industrial. And even though you do have this, and my point earlier about the thrifting, you know, the amount of silver that goes into a cell, a finished cell, is only about 30% of the level of a decade ago. That's how successful companies were after silver hit $50. And they haven't forgotten that, and they haven't stopped trying to thrift on it as well. Now, the amount of thrifting year by year now is really modest. But what you do have is a whole range of technologies. Some of them are very high silver containing, but there are other ones which contain a lot less silver. Now, none of these have been commercialized yet. And so we don't want to, you know, over sensationalize that impact. But it's something just to be mindful of. Because if I can be, you know, quite blunt, if you're an industrialist, you don't really want to use a precious metal because of the price volatility. You use it because it has qualities that you can't get anywhere else. And that's why you use it. You're happy for that trade-off. But at the same time, you are trying to thrift. So we do think that industrial demand going out a few years will continue to strengthen. And, you know, that we do think that PV or photovoltaic demand will continue to gain as well. You know, coming out of COP26 and the environmental trend there, already we've seen very strong commitments, or, you know, lots of new capacity, and we're seeing more countries installing new capacity as well. So I think it's an exciting future. The question, I think one question will be, and we've certainly spoken about this over the past few months with some of our contacts, efforts to try and recover silver from the end of life PV cells. You know, that could certainly add to scrap. So that's something we will watch out for. Now, I think, you know, before we get too concerned about that, where it is very economic is some of the really old cells that you were installing, you know, 10, 12 years ago, when you did have those much higher loadings of silver. There's a big question mark as to whether the sales being stalled over the past 4 or 5 years, whether it will be economic to recover the silver from them. And then the jury is certainly out on that. But that's where we come in. That's why we're speaking to people, trying to understand what's happening now, and then what may or may not happen, going forward as well. But we still are, I think the key takeaway is we are positive for industrial demand. We're positive for, a decent recovery in jewelry and silverware, led by India, which is so important, even though we think coin and bar demand will eventually taper off. But the key takeaway is we think the market will be in deficit for the foreseeable future.
Philip, I had one additional question, and this is the $1 trillion question. This is the white elephant. This is the elephant in the room that no one wants to talk about. And what it is the debt. And so when we look at silver, we look at it as a commodity. We look at it as an industrial commodity. It's consumed. A lot of it's thrown away, or they're still using it. It's in your house. It's in different industrial applications. But when we try to understand that silver is also a store of value as well as gold. And I guess the folks at Metals Focus and you must have some kind of conversation from time to time, because we continue to see the debt in the world increase, especially we've seen in the United States and China. And so when you look at, yes, there's a lot of money flowing into dollars, there's a lot of money flowing into bonds, and there's a lot of just money, 40 trillion in the global money supply, all different kinds of money. So I think the issue is one of the most underappreciated factors about the precious metals is that the world is continuing to add all this debt. Hopefully it's going to continue to be serviced. They're going to continue to add it. But if the debt gets into trouble, and I have my analysis about the energy, which I won't get into yet, but if the debt gets into trouble, isn't that when the precious metals, their real values tend to be much more important than they are now?
I think that's a fair point. I mean, although I would say that doesn't necessarily form part of our base case, but it's certainly a considerable upside risk for gold and silver. If interest rates continue to rise and this debt, which has been a lot of it built up at very low rates, where does that stress emerge, and what does that mean? And will you therefore, will you see the dollar unwind? Would you see a flight into gold and silver? So I would say yes. That's certainly a possibility. As I said, we don't have it as our base case, but it's one of the risks that we obviously do talk about. So I think that is possible. I think the concern would be, what will that do? If you think about the money coming in, the level of volatility that would introduce, how sustainable would the price upside be? Or would it just simply lead to just a very heightened, obviously much higher prices, but just heightened level of volatility as well? And it's fine as long as you've got the investor flows, come back to my earlier point, as long as you've got the investor flows coming in, day out, to support those higher prices. But if you've got that higher prices, so if you've got the higher price volatility caused by those investor flows, the damage to the underlying demand would potentially take away some of the upside steam that you would see in the marketplace, more so for silver than gold, given, as you said, Steve, how important the underlying fabrication demand is in the silver market. So I think that's just a risk that I would highlight, that we must never, well, in my humble opinion, try to look at the silver price divorced from the underlying, supply-demand balance.
That was well said, Philip. I appreciate you including that. Let's say the demand side, once we have a spike in price, with thinking about how, let's say, sustainable that spike could be.
Yes, absolutely. Yeah.
Steve, was there anything you wanted to add there?
No, I think, Philip, thank you very much for sharing your information. You know, I have a certain analysis that I look at about energy, the problems we're going to have with energy, and it's going to impact the value of most of all assets. Most negative and others positive, but that's my analysis. So if you had anything else to share, or if anybody else had any questions for Philip, this would be a good time, because I was going to go into that kind of analysis, and I don't know if that's something that you want to be a part of. So I just wanted to provide the floor for anybody else, or if you had any concluding thoughts that you want to provide us.
I think from my side, well, firstly, you know, I want to thank, you know, you and Tom for inviting me and making this evening or this afternoon happen. I think, as I said, you know, I'm hoping that people have got a slight idea of how we approach the market. It's certainly anything but a desk-based job. So, but I hope people have got maybe a flavour of how we put the figures together, and as I said, the interrelation that we see between the, you know, the retail, the institutional, and the underlying, you know, supply and demand. But it'd certainly be a pleasure to be a part of this, and happy to take any questions anyone may have.
Okay, that's what I was going to ask, Philip. If you're willing to stick around for a bit to answer some questions, so I'll open it up here. If anybody wants to ask questions, either put your hand up, request to be a speaker, or you can DM them to me as well if you'd like to. So we can have Wall Street Silver. Is that Ivan?
No, it's Jim Lewis. Thanks for adding me.
Hey, Jim. Thanks for joining us.
Hey, Philip. Thanks for your data. We appreciate it. Question is, you know, if Metals Focus and CPM Group are really the two primary data, you know, sources for this information, and CPM Group, they count things. I'm wondering if you know how they count things differently than you, because your number, I think, was 280 million ounces for investment silver for 2021, and Jeffrey Christian, his number was only 100 million ounces. And I'm wondering if you know where that discrepancy comes from. Are you guys counting things differently? Because I mean, I interview these CEOs of different companies like SD Bullion or Miles Franklin, and I talk with Bobby Blandis at Silver. I mean, you add up all their silver numbers, and just 4 or 5 companies gets over 100 million ounces per year. So I'm just wondering if you know any details on why CPM Group has such a low number in their investment silver, and where, I mean, from everyone I've talked to, your number at 280 million is probably closer to accurate for investment silver demand. But just, do you know where Jeffrey Christian's getting 100 million?
In short, no, because I haven't looked how they do it. And being one of the owners of Metals Focus, I got to say, keeps me busy anyway. I mean, just to give you an idea that our, if I can lift the lid a little bit, our coin figure, which is not just a bullion coin, but I'm talking about manufacturing, not investment. So when I say the difference there is, including, say, what's a good example? I don't know, the America the Beautiful. Whether you want to put that in investment or not, I don't know. But those kind of coins and the limited issues that the US Mint brings out. But if you look at that globally, our coin figure for 21 was 154. So that's our coin figure. And our bar figure was 125 globally. And just as a reminder, our bars includes 1 ounce rounds, as I've probably said quite a few times. But no, I honestly have no idea how they do it, how anyone else does their figures. I think our approach is thorough. We've got a really good team, and I'm not criticizing CPM. They do their thing, we do ours. We think our approach is pretty robust, and we're quite comfortable. We do revise figures. We you know, if someone comes to me and says, you know what, I told you that we had shipped mainly 1,000 ounces into the COMEX. It turns out that we did a lot of silver kilos. We've got to go back and change our figures. That does happen. You will see revisions in our series just because it's in print, and we try to reflect the market as best we can when we go to print. Revisions happen, but I think in terms of our methodology, I think we're fairly comfortable with how we do things.
So when you come up with, you said 120 something million in just like sovereign mint coins, did I hear that correctly?
So our figure there's not just sovereign mint. So it could be, what's a good example? I don't know, the Monnaie de Paris is making 10,000 coins for the Cook Islands, whatever it is. I guess that also is a sovereign mint, to your point. But if someone is making a private coin. So, for example, there are mining companies in the US that would go to one of the fabricators in the US and say, "Can you produce a coin for me?" That's not a sovereign coin. And
I call that like a round, right?
So it could be
American Eagle or Canadian Maple Leaf or Britannia or Philharmonic or Krugerrand or those are I call those coins, right?
Absolutely, yeah. So I don't have that figure stripped out, but our figure is, as I said, if you want to take this offline, I can share a total for that. I'm happy to do that.
Well, I just sent you a message on LinkedIn to.
Oh, did you? Okay.
Our YouTubes, and we can dig into this more.
All right, appreciate it. But obviously what we don't do is we don't talk about individual countries over and above. So, for example, if you look at the silver survey and you look at the coin table we have in there, and you look at, say, Austria, let's look at Austria. That figure isn't just a Philharmonica. It's, say, any commemorative coins they produce. It would still be part of that. We don't include commemorative coins in our investments. Now, you can argue that some people buy those for investment and some don't. We've just taken a company decision that although it's part of our supply-demand balance, it doesn't go into our coin fabrication. So it doesn't go into our physical investment, if that makes sense to you. But we are counting it in terms of an ounce of silver being consumed. So we're not missing it out. But so our total coin, what we call coins and medals for 2021 was 154, and our bar figure, which is where you'll find the 1 ounce rounds, was 125.
Okay. My other question, if I can ask one more question, I appreciate it.
Please.
The recycling number. A lot of, I've interviewed Keith Newmeyer a few times, and he's highly critical of the recycling numbers that are published out there. He thinks, he told us he's invested in like 3 different recycling companies, all of which have gone bankrupt because they can't make money recycling less than $70 an ounce. And, they throw chemicals at these circuit boards and it's just not worth it. How do you guys, and he said he's also critical of the recycling numbers just because most of these companies are private and don't even provide the data to anyone. So, I'm not trying to be critical of your numbers or anything.
No, that's fine.
That's too much, but I'd love to know where you guys come up with the recycling data and how do you know it's accurate?
Well, I would say our recycling is a series which is certainly open to the most, the widest margin of error. But also, to my point at the very beginning, that most companies, be it on the jewelry or silverware, from a fabrication standpoint, I'm not talking about the Tiffany's of this world. I'm talking about all the Sterlings or Jared and Kay. I'm talking about the manufacturers. Most of them are privately owned. So you've got to gain their trust. So what do we do in recycling? We break it out both sectorally and also by country. So, for example, my job, if I think about the US market, my job, along with my colleagues, is to speak to the companies that are doing the change-outs for the EO, the ethylene oxide, understand what those guys are up to, understand how much silver is contained, what are the drivers there, what's affecting the rate of change-outs. Is it that, for example, there's been an economic slowdown and therefore they take the opportunity for the change-out? Or maybe there's an economic slowdown, they're less profitable, so they delay the change-out. You have different drivers with the same backdrop. So it's our job to get out there. But I would disagree in terms of the electronic scrap. There are huge volumes being recycled. There are some huge heavyweights in Europe that have been adding capacity over the past few years. Do they tell me how much silver they recover? No, they do not. But you've got an indication of what's going on, and you can try and track it from the silver that is going from that country into other places. You can benchmark these things and build models. And what we do with some of our models, we then take those to the market. I go and speak to someone that's recovering and say, you know what? For every ton of cell phones, we assume this many grams of silver. What do you think of that? And they may say, well, you know what? Your figure was good 5 years ago. You've got to knock it down by 10%. And then we go back and adjust. So we're always trying to validate our figures. But there are contacts that won't speak to us. Not everyone opens their doors to Metals Focus. I'm not that arrogant. And as more people speak to us, we gain their trust, so information improves. So we will, revise figures. But I'm fairly comfortable with our recycling series. It matches what we see. And there are plenty of companies, I could show you them in the US, that have been expanding, doing fairly well, I would say. Look, there's also an informal nature to this. We think about parts of the Indian market, highly fragmented. Are we missing stuff there? Possibly. So there are limits on some markets of what we can do. That's why it can be quite estimated, or the degree of accuracy varies by country. There's no doubt about it. But yeah, so it isn't the most estimated series. But again, it's, we're out there all the time, especially now post-COVID, if you want to call it that. Again, seeing people, apart from across China, but it's just trying our best to understand what's going on, and hopefully we reflect that.
Yeah, those were my two questions. Thank you very much.
Happy to help.
Thanks, Jim. I had another question here, Philip. Do you know what was causing the silver blank production issues?
So that's a little company specific. I think what you had, if you're going back last year is, or earlier this year, I guess is what you're referring to, because I don't think there's many issues now. There are some, but I don't think they're as pronounced as they were by any stretch. I think the challenge is that the market for the coins can run pretty cold. Those of you that been around, say, the early 2000s, it was a pretty bleak time. If you were a dealer then, you were trying to market coins by the issue year, saying, well, this issue year was quite low, you should buy that, rather than thinking about, such was the paltriness of demand that they were just trying whatever they could do. And so when it suddenly runs hot, you don't always have that capacity to turn on from a blank point of view. It's all very well for people to install that extra capacity when things are going incredibly well, but who's going to fund that, or what are they going to do with it when a tap gets turned off? So you're always going to have that challenge as well in the marketplace. And it wasn't just about blanks, as it was about the minted bars, be it 10s, 5s, 100s, and also kilos, I would suggest. That's why you had so much last year coming in from places you would never see it. You'd have never seen product coming in from Turkey or Switzerland or Australia, unheard of, from a minted bar product. But that's how hot demand was running. So, and you had extended lead times all over the place, be it coins or bars. I'm sure every dealer, I'm sure most people on this call or this discussion, I think you'd be in a minority if you spoke to a dealer and they said, sure, we've got what you want and the premiums aren't high. Didn't exist. So I think it was running all over the place. But I think that's always a challenge. If you're, say, supplying the US Mint or others, not just the US Mint, but others, who's going to fund that extra capacity, when things suddenly the tap's turned off, who's then going to provide that? Because no one's going to give you guaranteed, I'll put this capacity in as long as you give me 500,000 ounces a week of guaranteed demand. No one's going to do that. So it's an incredible risk. So I think, when things got really hot, that's why you had that suddenly a lack of blanks in the marketplace.
Perfect. Thanks, Philip. Go ahead, Steve.
Yeah, Philip, in also doing my research, I believe one of the important components of the silver round market is the silver shot, because it takes silver shot to make these silver rounds and silver bars. And so when there's a huge demand for this product, even not just the capacity to make blanks, but the capacity to get the silver shot from refiners, that could also, and I've heard that has been difficult. That has been a tightness as well. And who is going to ramp up the capacity to produce more silver shot to make the bars in the round product?
I think you just hit the nail on the head. I think, Steve, if you want to job as an analyst, let me know. I think, what we we certainly see that. And again, to your point, who's going to install that capacity? I think related to that was the strength in demand, because if you're a refinery, then, and you've got a choice, do I put my capacity to making the shots or the grain, or do I produce a minted bar which has got an incredibly high premium? Where am I going to divert my resources? I appreciate it's not the same machinery, et cetera, but in terms of from a top-down corporate standpoint, where am I going to allocate my finance or my balance sheet? Then you're certainly going to do it. You're going to direct it towards the minted product. And I think that's at times why you even had, say, 1,000 ounce bars in short supply, because if you could, you were just producing where these eye-watering premiums were that maybe you aren't going to see again in your lifetime.
Yeah. Hi, Tom. Hi, Phil. I had a question about your demand numbers. Did you count military demand for silver for the next couple of years?
Well, that gets very delicate, because if I go to someone and I ask them, for that can be a state secret. But what you do find is we know who, say, the producers of the silver powder or the flake or the strip or whatever it may be. We know who these guys are. What sometimes we don't know, and I'll be honest here, is we don't always know. They know who they sell to, but who is the ultimate consumer of that product? Does it end up in a military product? That is something that we don't always have sight of. That's why, as a company, we don't really have a category called, military or defense. What we do know is, as I said, company A or B would say, well, you know what, we are seeing higher orders. We suspect it could be military, but it may not be. It could be something quite, much more innocuous. And then on the flip side, on the recycling, we like to try and capture, the silver batteries coming out of torpedoes. Is anyone going to talk about that openly? Not necessarily. They would also be sworn to, secrecy as well. And so it may get rolled up into another category. So ultimately, I guess what I'm saying is we would capture the silver, but not always do we know where the final end use is. And if I could just go off on a slight tangent, if you just indulge me, we have that challenge with the automotive sector. If you speak to an OEM, they know to the ounce how much PGM is going into their autocatalysts. Few of them would have any idea whatsoever how much silver goes into a car. It could be 1-2 ounces, whatever it may be. And so it's also very difficult, again, to the same point as the reason I mentioned this. We know the guys that are making, say, the powder, flake, strip, so on and so forth, the sheet, they don't always know where it gets consumed. So we do have to make assessments and sometimes make assumptions about where the ultimate end consuming sector is, even though we feel quite comfortable that we're capturing the ounce to go into our supply-demand balance.
Am I correct in assuming the military use of silver will come in waves as opposed to constant demand to replace all the missiles and the stockpiles that they've been using in Ukraine?
I think there'll be some of that, but you think about testing and so on and so forth. So I think you will certainly see a pinch point now, but given where military spending can be, I think you do through the years have a fairly constant spend with a kind of spike that you would see now as well. And I think the other interesting point, just if I could just add, when we talk about thrifting, from a defense point of view, that's one category where you rarely see it because, performance is far more important, as you can imagine. And so it tends to be, it could be a multi-year contract to supply a silver-bearing component. And so the silver content of that component remains unchanged for quite a few years. And then you can have, say, a step change lower after a period of time. But at the same time, overall, it's certainly one area where the thrifting is a lot less prevalent.
Thank you, Phil.
No problem.
Interesting question. Thanks for that. If anybody has any more questions for Phil, we can take a couple more before we let him go here.
I have an unrelated question. I'm not sure if Phil could answer it. but I was considering what is the global average for all-in sustaining costs of producing silver. I believe it was $20 a couple months back before the rise in energy. Is that something Phil would know?
It's something that I should know. I will keep ad-libbing. While what I'm going to do is just bring up a report, and hopefully I can produce a figure for you. Maybe on one of these calls or the discussions in future, if it's of interesting for the listeners and for Tom and Steve, we have our director of mine supply. So I think in terms of some of the questions that have been raised, how much of the silver is a potential of, one question earlier, which I thought was really interesting, is any silver that we're missing. That's the kind of thing that he can give you a little bit more. So if we look at our World Silver Survey that we produced. Well, this is for last year. I mean, for 21, you had all-in sustaining costs around the $11 mark. That was that had tiptoed lower. What I'm going to try and do, because one thing we produce for our subscribers, we do like a 5-year silver forecast that we update 4 times a year. That doesn't necessarily have like an all-in sustaining cost forecast, but what we try and do in that report is to include the latest figures. And I think because obviously, as you'd expect, costs are fairly delayed, there's a bit of a lag in terms of those coming out.
The reason I was asking is because a couple months ago, we saw Cameco, the uranium miner, shut down MacArthur Mine, and they actually stood for delivery on the COMEX, which was a lot cheaper than them producing. So my question is, at what price of silver do the miners shut down the mines and start taking delivery on COMEX because it's a lot cheaper than producing at a loss to meet their contractual obligations?
I mean, we've had costs move up, and that's more the upper end of the line. If I look at where we look at all-in sustaining costs against the average silver price, then the first quarter price of this year was about $24. And then you can see you've got, on an all-in sustaining basis, you've got probably 20% of the industry that would be underwater. Now, if you bring that down to below 20, suddenly you get into about 25% on an all-in sustaining. Now, as you know, probably better than anyone else, a mine will not necessarily react immediately to those weaker prices when you think of the cost of either shutting down or going into care and maintenance. You will keep things running for longer. And bear in mind, of course, we are we're not diminishing its importance by any stretch, but we're considering 30%, roughly 25-30% of the industry in terms of the primary silver mines. So I think we do have some way to go, but it's without doubt, there is a percentage of the industry which is struggling a little bit. And I mean, I know Tom offered me the opportunity to put some slides on here, but what I could do, okay, it's quite late in the UK, but I'll be happy tomorrow to send through a couple of slides. I don't know if that works with publishing these somewhere, but I'm happy to bounce that through to Tom and Steve if that assists for those guys and for everyone else on the call.
Yeah, we can put them up on our Twitter tomorrow, or whenever you get them to us, Phil, as a response to that.
Yeah. I mean, it'll be a couple of slides. You let me know how you want to, format it, et cetera. But I'm happy to share, because I think that was a really interesting question. So this on it will show the first quarter price. It doesn't take a rocket scientist to imagine a lower price and what the curve could look like as well. So happy to do that.
Okay, and I just want to interject here. I think many of the people who follow the silver on Twitter have seen my charts, and my methodology of the total cost of production for gold and silver is different than the Metals Focus as well as a CPM group. And I explain why that is, because we have to understand first, the all-in sustaining cost is a non-GAAP accounting measure. It's a kind of a way to measure the what's happening with the cost production in the mining industry. And so when you throw out 20, that's the number I'm putting, and that's the total, because these miners do not make money. They have to pay taxes out. So when we understand a total cost. I look at it a little bit differently than Metals Focus and the CPM group. And I was going to get into that analysis in the second part and to go into a little bit more detail why I differ. But even that being said, I believe the primary miners are being hurt a lot more than the gold miners because they have a much more larger cushion in their cost of production.
Okay, well, I would defer to you only because it's not my area of expertise. So I think actually it could be a really interesting debate between you and, as I said, my colleague Adam Webb. So maybe that's something to set up to really delve into this in a little bit more detail.
That would be great, Philip. Yes. And again, thank you for coming in, and because I know there's been some questions about the silver data, and so I appreciate you taking your time off. And I don't know what time it is now in the UK, but it's probably pretty late there. So I do appreciate your time.
It's not too bad. It's about half 10 at night, so I wouldn't want to be anywhere else. So,
well, thank you.
Thank you very much, Philip. We really appreciate it, and I guess we don't really have any other questions at the moment for you, but happy to have you stick around if you'd like to.
I probably will. If the questions are finished for now, I will probably make a move. But if anything comes up afterwards, if anyone's okay to send me an email, happy to follow up. And I certainly hope this is not probably the end of the debate, but more the beginning. But certainly happy to carry on debating these and discussing with you guys. I think it's been a lot of fun, and as I said at the beginning, I'm grateful to Steve and Tom for the opportunity to do so.
Well, we really appreciate your time and input as well. Thanks, Philip.
Yes, and if anyone gets a chance, go to metalsfocus.com and click on the team. And if you look at their team members, their consultants, it's a very large number all throughout the world. So I put a lot of faith that their data is the best data out there for the silver market.
What? You don't trust Jeffrey Christian's numbers, Steve? Is that what you're saying?
Well, that we'll get to. Well, I don't know if I trust it, but let's say I disagree for professional reasons. As a professional debate, I disagree with some of his data. Yes.
Okay, Steve, do you want to go into your second part of what you wanted to talk about now?
Sure, and thanks everybody. I think there's the two things I wanted to kind of discuss in the second part is number one, and there's never a personal attack. It's always looking at disagreeing with the information, and I can understand how the consultancies respect each other, and that's important. But I don't have to do that. I do respect, but I'm able to discern between the information and provide my analysis on why it's different. And so the first thing I want to start off with is I look at a much different future for the precious metals and silver, and that's due to my ongoing analysis about energy and how we're going to get into trouble with energy. And we're starting to see that take place in Europe and now in Asia, and we're going to see more problems with third world countries like Sri Lanka. And this just isn't due to policies or the Russian-Ukraine war. This is due to the world trying to run the car at 100 miles an hour. And it's very hard to do that over a long period of time. Things break down, tires blow out. And so we're trying to run an economy at 100 million barrels of oil production a day. And the decline on that every year is so severe, we have to replace it. And so this is going to become increasingly problematic. My analysis suggests by 2025, we will see the peak in U.S. shale production and likely the peak in U.S. shale gas production. And that's been the major driver of the global energy growth, oil and gas, since 2008. That's been the leading driver. And so if that driver is gone and we're starting seeing weakness in other energy, then it's the perfect storm because then you can't generate more GDP growth. It becomes increasingly impossible to service debt. And so what the central banks are trying to do, I've got a little different outlook on them. What the Fed and central banks are trying to, they're just trying to keep the lights on. They're just trying to kick the can down They're just trying to put fires out. And so I look at it differently. I don't look at it as manipulation. In the same way, maybe as a chiropractor manipulates a body, that's what they're trying to do. They're trying to keep the lights on, and it's causing a lot of problems now. And the only way that works is if we continue to get energy growth. And now we're starting to run into real problems with energy growth. So I think as time goes on, when the debt gets really in trouble, we're going to start seeing huge implosion of the debt bubble. And then what is a debt? It's someone's asset on the other side. And then asset values are going to collapse. And this is when I see a big problem with stocks, bonds, and the value of real estate. And so it's unfortunate that this is going to happen, but this is what I see happening. And that's when I start to see institutions and the retail market move more into the metals, because a lot of the financial assets, especially money, is going to get into serious trouble. Even though we haven't got there yet, we're moving closer to that. And so I've got 4 things I want to talk about CPM Group that I differ with, and just to kind of provide my analysis. But if anybody has any questions about the energy and what's happening with the metals in regards to that, I'd be happy to answer anything before I get going. Or if anybody has a question, or if they want to take over for a minute, that's fine too.
I think the floor is yours, Steve.
Okay, well, one of the things that Jeff Christian came out with this, the CPM Group, Silver Facts and Fantasies, and I'm not personally attacking Jeff, but one of the things he said is that we're not running out of silver reserves, and this is true. There's plenty of silver in the ground, but what happened in the ancient Roman Empire, they didn't run out of silver ore. They ran out of wood to cut down, to make charcoal, to smelt metal. That's why they peaked in silver production at about 75 AD. And then as production collapsed, because they couldn't get enough wood, they debased the denarius. And so what's happening now, even though there's a lot of silver reserves on the books, the problem will come that we're not going to have the energy to extract and mine and process this silver, as well as gold, base metals, so on and so forth. And I start to see that pick up speed after 2025. I start seeing that much more of a problem. And so that's the first thing. And then the second thing is, Jim brought this up from Wall Street Silver. I do not know how Jeff Christian can come up with 100 million ounces of physical silver investment demand for last year, because he shows 130 million ounces for silver coin demand. So I guess he doesn't even include rounds. They're not even included, the silver rounds. And I guess bars were just negative. So it is interesting that Jeff was able to take 130 million ounces of physical silver coin demand and come up with actually less overall silver demand of 100 million ounces compared to the 279 million that the Metals Focus, Philip Newman, and the World Silver Survey put out. So I find that quite interesting. And if you go to Metals Focus, click on their website, click on their team, you're going to see over 20 consultants all over the world. If you go to CPM Group, and anybody can do this, it's no secret. There's 4 consultants. There's 4 we call it consultants or analysts. So when you compare 4 to 20, you're just going to get a much, I think, different product. And so that's one of the things that I see that's a major red flag for CPM Group's investment data. One of the things we brought up too was someone brought up Nostradamus. You brought up about the all-in sustaining cost. Now, I don't criticize the all-in sustaining cost that's put out by the World Silver Survey. It's also for gold and silver. It's actually a bit more accurate for gold than it is for silver. But I'll give you an example. Hecla came out with a $7.64 all-in sustaining cost for the first quarter of 2022. That was their number. But they only reported $4 million income on I think it was 184 million in revenue. So if their all-in cost, or their silver cash cost was 764, how come they weren't making a lot more money? And the thing is, the cash cost and the all-in sustaining cost a lot of times does not provide the profitability of a company. And that's why it's a non-GAAP accounting measure. And so I have a much higher number. My number is $20 right now or more, all in cost for the primary silver miners. And it's like $1,500, $1,550 for the gold miners. And when the Q2 data comes out in a few 2-3 weeks, they're going to start reporting all their second quarter. This is going to be very important because this is when we've had really high prices of energy and material costs, but lower metals costs, even base metal. And so we could see the real truth of what's happening in the primary silver mining industry, which is doing a lot worse than the gold mining industry. And the difference between CPM Group, which I don't understand, and the Metals Focus World Silver Survey and the Gold Focused, CPM Group still use cash costs. The cash costs, they disclude so many things. And so his number is like $8 for 2021, $8.24. That was the cash cost for producing silver in 2021. But it conveniently leaves out a lot of costs. And so, unfortunately, I think this is a major issue. The all-in sustaining costs are a little bit higher, but I don't think they provide a realistic number of the profitability of these companies. And I provide that analysis for subscribers. So that's it. That's where I differ. Even though the World Silver Survey uses the all-in sustaining cost, I don't criticize them, but I do criticize Jeff Christian for using a cash cost. But because everybody else seems to have transitioned to the all-in sustaining cost because it's a much better approach for the mining industry, even though it doesn't provide all the costs. So does anybody have any questions on that?
I do on that one. I just did a video and interviewed Chris Ritchie at Silvercrest Metals on this very topic. And if you ask him, all-in sustaining costs, one of the key things they leave out of that number is the cost of acquisition of the project itself. So if an existing producer goes and buys some project, some future developmental mine off of some other company, and they pay, I don't know, let's say $200 million to acquire all the right, that's not even included in that all-in sustaining cost or anywhere in that calculation. If you were to actually include that number of what these producers pay to acquire the project, I mean, the cost per ounce just blows through the roof. Most of these companies over time just lose gobs and gobs of money if you include what they actually pay to acquire the projects.
Jim, I agree with you. And I've done analysis looking at the top gold miners and even the top silver miners for the last 15 years or so. And what also isn't included besides that is the share dilution, because they really weren't making enough money for many years. And their fat years aren't that many. There aren't a lot of fat years. There's okay years and there's some tight years. And there seem to be a lot more okay and tight years than there's the fat, profitable years. So what they've done to continue expanding production is they've done share dilution. They've just have more shares or they're adding debt. And they're not including that in the all-in sustaining cost. And the all-in sustaining cost, you know what that is really? That is the going out of business sale. Well, if you're going out of business, then you're not really an ongoing concern, right? You're getting ready to shut your doors down because it's all in sustaining. Then it's bare bones. You're not going to put any more. And they call it, they don't even include expansionary capital in that number. And it's not expansionary because these mines are currently depleting. And then you've got to find a new mine. And so even though it's expansionary, it's really, they should call it replacenary. It should be replacement capital expenditures, not expansionary. Because if we look at a lot of these miners, they're just the top gold miners, their production has actually been falling. It's been trending lower, not higher. Some silver miners have higher production, but yes, that's why the all-in sustaining cost is a non-GAAP measure. And so that's why I try to keep it simple, stupid, and provide a more total cost. And one last thing, and this is where Hecla comes at a very low cash cost or very low all-in sustaining cost. If the companies are doing the same thing, but because one company has got a lot more byproduct zinc, copper, and lead, and maybe gold, and what they do is they take that as a credit and they deduct that from the cost. But that doesn't tell if the mine is profitable. It just makes the all-in sustaining or cash cost lower because they have a lot more, let's say, zinc or lead or copper production. Because if you look at them, they're both making about the same money. But one has a very low cash cost or all-in sustaining cost, and one has a much higher. And we could look at First Majestic. It has a higher all-in sustaining cost because it's producing, or was up until recently, until it's acquired some gold mines. It has more primary silver than the base metal. And so it's kind of an accounting gimmick. And again, in the gold mining industry, it works a little bit more because there's not a whole bunch of byproduct credits or revenue coming from the gold mining. But in the primary silver mining, there's not a lot of real primary mines. There's very few. Even though they call them a primary mine, they're producing a lot of zinc, they're producing a lot of lead and even copper. So I just wanted to share that.
I would agree. Most of the primary silver, look at companies like Pan American Silver. Silver's in its name, but only 25% of their revenue is coming from silver. It's like over 50% gold now. They should change their name to Pan American Gold or something. And you see that just throughout the industry. So many silver companies are barely silver companies anymore. That trend is continuing. You probably have the data going back farther than anyone else, but what were the numbers 15 years ago for primary? Right now, it's 27% of silver comes from primary silver mining companies. What was that number 15 years ago, Steve?
Yeah, Jim, it was, I think I've seen 32%. We're not talking 35, 40, but it was higher. And the reason why it was higher was because silver was the average price in 2011 was 35, and in 2012 was 30. And so if you were a primary silver mine, you were doing really well. And the reason why we see the primary silver miners moving more towards gold, because the producing gold tends to have better margin. There's a little bit more profit there. But producing silver, and we're seeing that now, it's like, you open the door and someone hits you in the face. So you shut the door. And you open the door and someone hits you in the face and you shut the door. Well, because silver is such a tough business as a primary miner, not as byproduct, but as a primary miner, and the prices have kind of underperformed the market for various reasons, which I think are going to change. The miners have said, well, either we can continue to open that door and get hit in the face because the cost is so high, or we're going to invest now into some gold mines to help fortify our balance sheet, the margins. And so I think that's why they've moved more towards gold, because gold tends to provide a more guaranteed higher margin than the primary silver miners. Unfortunately, that's the way it's been in the last 10 years.
So, I just had an interview with Jeffrey Christian a few weeks ago, which I did not put on YouTube just because, overall, I just didn't like the content of where the interview went. It was very condescending. But if you ask Jeffrey, he'll go on and on and on about there is no shortage, there is no problem, the world is well supplied, there's no shortage forever, basically, into the future, if you talk with Jeffrey Christian. And I know that you feel differently, that there is a supply that is coming probably in the if not just from the problems of silver ore grades getting worse and mines producing less, the demand side whether it's solar just running away with it, and solar demand just eating up the bulk of global mine supply. I mean, do you see that cliff coming in the future, 5 years, 10 years down the road?
Jim, I do. And I need to put out, a video or two on my complete analysis of this. There's many different things, but I think I do agree with you. I find it interesting because I don't know why Jeff Christian has such a viral or a virile sense of the community, because one of the things that I say, and I don't criticize Metal Focus for this, because I take them for what they are. They're putting out data. My analysis about the silver market and the coming much higher prices of gold and silver, that's my analysis. That's different. But when I look at CPM Group and Jeff Christian, I see something's wrong. There's something wrong with that information, because it almost, why do you continue to do cash costs when everyone else is moving to all-in sustaining costs? Why are you putting out 100 million ounces of physical and silver investment? Now, he'll probably have a reason for it. And so I disagree with him on those things. And then one of the biggest things I disagree with Jeff Christian, and even Ted Butler, has to do with they just forget about energy. And this, I call it the energy tooth fairy. We get up in the morning and we just think energy is always there. And without energy, we have no economy. And so Jeff Christian and
Germany's figuring that out right now, huh?
Yes, Germany is figuring out, and this is not a temporary issue. This will become permanent. And how it shows in the future is going to be very interesting. But I think Jeff has a forecast of higher prices of silver by 2029. That's what he shows. And the reason why is because demand is going to be finally higher than supply. Well, I'm thinking that's 9 years, 7 years, 10 years away. Who makes a forecast on that? And one of the things he does not include is the energy. And so a year or 2 years ago, when I talked about energy, excuse my French, it went over like a fart in church. No one cared about it. Let's just talk about metal, Steve. Talk about silver. That's all I want to hear. But now my energy analysis is starting to make some headway because we're starting to see what's happening. And so I think the reason, Jim, we're going to see much higher prices of silver has to do only with one factor, and that's investment demand. I actually see industrial demand falling. Once we roll over in energy production, especially oil, then there's going to be less economic activity, less industrial demand. But I don't look at that as a negative. I just look at it, that's the way it is. And so what that does is it makes the valuations of stocks, bonds, and real estate very problematic. And we're starting to see that. But we haven't rolled over the energy cliff yet. We're just getting the first symptoms. We're bumping on the top. When we start going over, you're going to see debt implosions. You're going to see the pension problems, 401. And that's when the institutions, because if you've seen The Margin Call, the movie The Margin Call, I imagine you have. That was, I think, a fictional account about Goldman Sachs getting out of their subprime before anybody else. And so what I see is the exact opposite. I see institutions saying, things are getting really bad. We need to move into the metals now because the dollar is getting into trouble. Other currencies are getting into trouble. The debt is getting into trouble. Debt gets into trouble. Assets get into trouble. And that's when I see this move into the metals. And it's all going to be based on investment demand, first industrial, then retail and bullion. And it really doesn't matter if there's $1 billion, $2 billion, $3 billion. That's nothing compared to the 400 trillion of stocks, bonds, and real estate that are going to get in serious trouble. And so that's my analysis why I'm trying to get this message out, because a lot of people look at the manipulation of the metals. And if you want to agree with that, that's fine. But I think you need to understand energy is going to get so problematic. We need to be focused on what should we be doing now with knowing that's our future, energy scarcity. And the metals are going to protect your wealth, but we need to be doing other things besides that. So that's kind of how I look at the future, Jim. And I think we're going to start seeing that take place by 2025 and getting worse by 2030 and really falling off a cliff by 2035.
So, hey, Tom, do you want to do some questions from the audience? I don't mean to take over your spaces, but I see a lot of people want to talk.
Yeah, no, I appreciate your questions as well, Jim. Weimar, you have had your hand up here for a bit. Go ahead.
Thank you for giving me an opportunity to ask this fine gentleman a question. I'm now for almost 3 decades a participant in the market. So I have been 20 years ago. I have been watching data and saw this happening. Still learning about what gold and silver does. I'm really still learning, and I've read as much as I could, but I was so surprised it didn't really work as an inflation hedge as I thought it would, even with the smashing of or the spoofing or how you call it. But I so agree with you that the energy, all the mining business is very intensive on energy. So if energy prices go up, and I think if a reshuffling of energy, so for example, if Germany, what now happens is they just buy it from India or whatever, so it goes in other direction. But this has to be rerouted, and that's a costly business, I think, for energy. Before that is balanced, I don't expect Russia to be a player to Germany anytime soon. And I think this has consequences, many, for the system, so systemic problems. Also with the geopolitical, also I think is interesting for the metals. But what I mean is that if these energy issues need to be rebalanced, find new suppliers, or all this stuff, isn't going away anytime soon. It takes time. Even the sanction on Russia and all the crazy stuff, I'm sure it will at some point in the future will ease up again. But I think even also the attack on the FX reserves, all these kinds of things have changed a lot in the system. We see the system showing its bowels ever more. On the reverse repo, we see it. We see it on the euro-dollar futures. We see the bowels of the system. And I think what we see a total clusterfuck, sorry for the word, we see a total clusterfuck of many things happening. And I think this is the moment where we really going to see precious metals. And I'm really restrained with trying to sound like a gold bug or something, because I just try to see it as a serious asset. And I think the strongest case for silver is exactly, and also gold, for exactly these kinds of situations. But I'm so curious how you think systemic risk or rerouting of suppliers in energy plays a role in this thing, and the turbulency on the currency markets, how that works out. Thank you.
That's a perfect question, and I tried to answer this in a recent interview that I did with silver doctors on the manipulation theme. I see the same outcome of the metals as most of the precious metals in the precious metal people in the community. I just see it for different reasons. And my reasons allow metals investors to be a lot less frustrated. Because if we keep saying, some people say, well, it's going to get to 50 and it doesn't get there and it goes to 18, then you feel frustrated. And I'm suggesting an alternative view. And my alternative view is this. The market is driven by the institutional professional investor. Why? It's like E.F. Hutton. When E.F. Hutton talks, everyone listens, the old commercial. Well, when the institutions move, they control 80% of the market. It's not the bullion buyer. It's not the person buying silver eagles. So we have to understand what the institutions are doing, whether we agree with what they're doing or not. It's like if you're in Rome, you do what Romans do. You have to understand their mindset. And this is their mindset. And I make an analogy If you go back to May 2020, they shut the pandemic shut down. And so in May 2020, the price of natural gas in Europe was $1.25 or $1.24. It hit 50 a few days ago. So back then, when you're an institution or an energy company and you're looking at natural gas, you're looking at a window. I call it a just-in-time window approach. Do I need natural gas right now? No, I don't. The whole economy is shut down. I don't need it. So people like in the United States calling up someone in Europe and says, I'm going to give you natural gas for $1. They laugh at them. I don't want the natural gas. We don't need it. A year and a half later, it's totally flipped. They're panicking now. They don't have enough natural gas. And there's a reason why Europe is in trouble, because they are the largest net importers of natural gas. If you look at their production and you subtract their consumption, they are the most heavily reliant on natural gas in the world. Asia comes in number 2. They're the second most reliant on natural gas, and they have the second highest price for natural gas. So when you understand institutions back in 2020 were doing business as usual, we don't need natural gas, the price is just going to be low. Well, I see the same dynamic taking place in the metals right now. You've got the Fed and central banks trying to destroy the economy enough to get inflation under control. That's what they're trying to do, because nobody wants to pay through the nose for gasoline and through the nose for energy and food. No one wants to pay that. And so they're doing what they think is best to crush the system enough to get these prices down. Well, do you think the professional traders, whether they're spoofing or not, but do you think these professional traders at these institutions, do you think they're smart enough to realize, well, if the Fed's going to do that, we're going to lighten up on our metal and gold, because we're not going to hold on to it if they're going to continue to crush this inflation. And so they're just easing up. That's how I look at it. They're easing up. Some of them have margin calls, like in Germany. They're having margin calls, so they're forced to sell their silver or gold. And so I think this is the crazy dynamic that's taking place. So right now, to answer your question, the institutions that run the market, they are looking at what's right in front of them. And what's right in front of them is, we don't really need the metals right now. We did a year and a half ago when they were shutting everything down, but we don't need them right now. Now, I'm suggesting when the energy cliff really starts to hit the world, these same institutions, what are they going to do? We really need the metals.
Yeah, exactly.
And so this is the dynamic that I'm trying to get across. And so when we understand, if we understand the problems we're going to have with energy, which we're starting to see right now, they're just going to get worse. And lastly, there is no supply that's going to continue to come on to allow us to continue to have more production. That's not there. And we've hit the peak. We may go up a little bit higher for a year or so, but it's really over. And the institutions and the world does not realize that. And so that's the dynamic, the light bulb that hasn't gone off.
But there's another thing, and I want to pick your brain on that one, because the ESG has crippled the financial infrastructure for financing all these things. It's partly causing also price rises, partly other things. Well, you don't have to be very precise there, but you know what I'm saying. It's a multi-factor thing. But when ESG crippled, it means, and now demand, goes down. And if you look to the OIs forward, then you see it's a very steep hiking series and a very aggressive turning. That's priced in. It's, of course, all probabilities might be changing over time. And that's how it works. But if you look now to the OIs curve forward, it gets like end series and then aggressive cutting. And what I think is, when somehow, I don't know when, but if somehow this get all stimulated again, complete like a temperature shock, because they have to cut again, and maybe even bond buying starts again, and we may have a Plaza Accord again, and because the dollar's going up too high, and Europe is completely paralyzed monetary. It's like monetary glue. The only thing they do is trying to keep together, hold on to each other, and that's about their complete monetary policy. They can't hike so much, and it is not even needed, because in the winter they have enough demand destruction to wish for, I think. But the problem is when they either that we see systemic problems rising, which wouldn't surprise me at all. If you look to Japan, the leak on their cap, or you look to China, or it's not all that clear, but it could be, you don't know for sure, but there are weaknesses everywhere, more than ever, I think. So at a certain point, when this kicks in, the energy still is a problem. Also, I assume, but this is I want to hear from you. Also, would be a problem for mines, because if the demand for energy goes up, if we get a kind of stimulated boom, it's most probably can't imagine. But what if we get a like this, really like the OI said, that we get a hike and then we get a strong cut and everything goes bananas. If there's some pickup, in demand, how will it squeeze its way through this crippled and also more rationate energy system? How will that work?
Well, you see, that's a good question, because we've never been there before. Well, we've been in recessions, and when you have a recession, the energy consumption falls a bit, but it didn't really fall much. Energy consumption, oil consumption didn't really fall during the 2009 financial crisis. It fell a little bit. It fell drastically during the pandemic shutdown. So I think the issue is this: if there's less energy flowing through the market, there's less goods and services. That's keep it simple, stupid. If the Fed and central banks start doing more QE again, they turn around, they stop raising rates, they start lowering rates. The problem they're going to be faced with, there's not going to be a lot more energy. And the only way you can have GDP growth, real GDP growth, is if you have oil production growth. And we can see that there is a definite correlation between oil production growth and GDP growth in the world. And so the issue is that at this point in time, in 2008, 2009, when the Fed lowered interest rates, the rest of the world lowered interest rates, we added 12 million barrels a day of oil supply. And most of that, 80% of that, came from the United States shale, which is a disaster. It's like a boom and bust. And it boomed, soon it's going to bust. So the world has relied upon this boom and bust shale. And so I think the issue is when they lowered interest rates, when they did QE, they had the energy to back it up for the last 12, 14 years. This time around, they're not going to have another 12 million barrels of growth. That's done. It's over. So it's going to be very inflationary. I just see very inflationary values for things we consume and very deflationary for things we own. Stocks, bonds, real estate, cars, all those things we own are going to lose value. Things we consume are going to still be inflationary because we have to consume those. We don't have to consume a car. And so I think that this is the generalization I see playing out as the energy becomes more problematic. I hope that answered your question.
Are you basically saying that they're going to print to compensate the lack of the energy, thus the economy? Are they going to compensate the GDP with printing?
Yes, and that's what they've been doing. 1997, you see, I call it, they're printing and adding debt to offset the falling energy return on investment. And that's what the Roman emperors did too. They debased the currency to offset the falling energy return on investment. And so now we're just going to see that at a much higher scale, much larger scale.
That's Weimar like policy, almost, I would say.
Yeah, and so I think the problem is they're going to try to do that at a time when there's not really enough energy growth, because you can get away with a lot of things when things are growing. When the party's going on, you can increase debt, you can print money, but when you don't have the energy to back up all that, then you start to get into a lot of trouble. And so I think that's what we're facing.
So what you get is we have this amount of debt that is just growing because interest has to be paid, and et cetera, et cetera. At the same time, we suddenly have a lower plateau of growth, much lower. So then we get this. We have so much money still in the system. I think better said, unproductive credit. So all we can do now is to add more unproductive credit, while at the same time having a lower goods and services. So it's now, because it's at a lower, and previously it was less of a problem because the activity was higher. Is that correct?
Yeah, no, you said it. You answered your own question. Yeah, they're going to have to. They've been trying to offset this falling energy return on investment of the oil by adding a lot of debt. Because in 1997, there's 97 trillion in global debt. Now there's 300 trillion, and you have to service that debt, and you can only do it with low interest rates. And so now when they're raising interest rates to kind of stop, they're really messing up the serviceability of this debt. And then that's even with oil production going up a little bit or remaining constant, the whole thing falls apart when you can't, when energy production starts to really fall. The whole thing starts to fall apart. And if we're witnessing the problems now in Germany and Japan from these energy problems, can you imagine when energy really starts to fall? So it's going to be volatile. We're not just going to have high prices. We're going to have lower prices, but it's going to get increasingly volatile. And that's when it's important to remain just, I call it, keep a level head, acquire precious metals. Don't worry about the day-to-day, ups and downs, because we're going to see much higher metals prices, but it's going to be volatile.
And I think to your earlier point too, Weimar, we've heard so many times repeated that gold is an inflation hedge, and I think if you look at the correlation over time, it can over a long enough time scale become an inflation hedge, but it is more a guard against systemic risk. When there's black swan events, very shocking events that happen to the system, that's when gold and silver really serve their purpose, and not so much as just a passive inflation hedge.
That's also how I was looking at it, that when we get a lot of stress in the financial system, and I see that in my own thesis is that stress will go very high, and I'm so thankful for because it makes a lot of sense to me. And it's also how I was thinking that if we get a lower production, because even without oil energy being a problem, I already saw a big debt overhang and an up-melting dollar right now. But I think you're right. I think that if stress goes up, and if there isn't a Plaza Accord or something, and we see the same clown car kind of monetary policy, we also might, get very. I think this volatility is going to be a wrecking ball. So I think as a systemic risk kind of insurance, it's still, like you say, keep level-headed, and I'm properly allocated, so I'm not worried. I'm just trying to make sense of what are the drivers of things, and I think that you're right that over a long time period it may be seen as a inflation hedge, but I think it shines when you get into low trust and low trust environments, and I think that's exactly the environment we are moving into. So very thankful.
Tom, may I add one thing? And I'm kind of a broken record on this, and this is I try to connect the dots. Our economy is nothing but burning energy. That's what it is. We forget it because we've taken it for granted. So it doesn't matter if we produce a car or a shirt or a pair of shoes. That's the economy, right? You buy a pair of shoes, you buy a car. No. It's the energy that went into all the different forms of energy and labor that went into making it. Because if you don't have the energy, you can't make the car, you can't make a pair of shoes.
That goes back to your energy tooth fairy idea, right, Steve? Everybody takes that part for granted.
We do, because we've continued to have the energy. And so I think what I want people in this group to understand, the reason why silver and gold are going to, the values are going to go up much higher, because what do? They store energy value. If the economy is nothing but burning energy to make goods and services, then what should money be? Money should store this energy value, because it's the number one factor of the economy. What's storing the value right now is fiat currency, is stocks, is bonds, is real estate. But all those get into trouble as soon as the check engine light, the oil production starts to fall. All of those things get into trouble, because my term I use is they aren't stores of value. They are energy IOUs. You have to continue to burn a lot of energy, more energy every year to give those value. The difference is a gold coin or silver coin, you don't have to do that. The energy is locked up. The value is locked up in the coin. Someone else has to trade you something of value. And so with all this paper money and M2 and M3 money supply in the world, all these stocks and bonds, people and institutions think they're a store of value because they believe in the energy tooth fairy. We're going to have higher and higher and higher and higher and higher production. They don't realize that all falls apart when energy production falls. I hope people can connect the dots. It's not about loss of faith. Well, it is. It's loss of faith in a system that was driven by energy and growth, energy growth. When there's no longer energy growth, the faith in that dollar, that fiat dollar or the bond, the faith erodes because there isn't the energy there to give them value. And I think that's what I'm trying to get people to understand, is that concept. That's the fundamental reason that provides the value of things, especially the precious metals in the future.
This has also gigantic consequences for taking debt, because debt is taking growth from the future to the now. So if suddenly everyone understands that the growth won't be there in the future because there's no energy tooth fairy, it means a lot of things for that debt. Everyone will get a shock.
Let's take a couple other questions here. There's been some guys that have been being really patient here. My Good Life or Speculator, do you guys want to jump in and ask a question?
Yes, Speculator 7, Martin Jimenez. This question is in regards to energy. In the mines, silver mines, gold mines, the input cost of fuel, what comes to mind is diesel. A company like First Majestic has diversified some of their fuel costs into other sources of energy. I wanted to ask the question of what are the top 3 sources today of fueling a mine? What comes to mind is diesel. And then the second part of my question is uranium reactor even an option? And if it is, how far down the road are we looking at this?
Good question. Depending on the mine, if it's a silver mine, a larger percentage of the cost is going to be electricity to process the ore. And if you're tied into the grid, you got to crush the ore, you've got to process the ore. It's very energy intensive. And back in the ancient Roman Empire, they would cut wood down trees, they'd make charcoal, they would use the charcoal to smelt the metals. We use electricity now. So whether that's driven by natural gas power, coal power, hydro power, it depends where the mine is located. But I would tell you, overall, the largest components of electricity for mines tends to be, if they're tied into the grid, is coal and natural gas overall. Some mines are so remote, they have their own diesel generators because they can't attach to the grid. But that tends to be more of a smaller minority than the exception. Now, the other aspect is the liquid fuel. And to get the ore out of the ground, you use earth-moving equipment. And most earth-moving equipment is done with diesel engines. So primary silver mines use diesel to extract the ore. But because it's such a higher grade compared to gold, most gold mines, almost all gold mines, most of them are open pit or maybe a combination. So they're moving 100 times more ore. And that's a lot of liquid diesel to extract that ore. But again, that's just the energy component of it. That's just, let's say, raw energy. Whatever material that is delivered to that mine, like lime to process the ore, the cost of that lime, or it was all the energy when you take it back to where the lime came from. It was all the energy that was burned to make the lime manufacturing facility. To process the lime took energy. To transport the lime to the mine, it's all energy. So everything is energy, even though it may come out as a material cost. Even the equipment they use, the trucks, it's all energy when you take it back to its common denominator. So energy is actually, when you take it to its common denominator, it's the number one factor for all the cost of everything, just about all consumables. Land is not based like that. And your question about nuclear or uranium, I have a very different opinion compared to, let's say, Doomberg that we've talked in several Twitter spaces. I don't see uranium or nuclear energy being a solution, because if we're going to get into trouble with oil, then there's going to be less ability for the supply chain is going to break down, and we're not going to be able to make these very highly complex components that make nuclear power plants. And same with wind and solar. And so I've said this many times, but we have new people. When oil production declines, it pulls down all other energy sources, especially coal, especially natural gas, and the ability to ramp up anything else. You just have less energy to make these parts. And so I think that's a dynamic that is really underappreciated.
Good Life, do you want to ask your question?
Yeah, my question is one of the things that I found insightful was talking about the all-in sustaining costs and there's a comment around, not even accounting for the acquisition cost of the actual mine in that cost, and just trying to, obviously form a business around any of this is obviously really difficult for these primary silver miners. And one of the things that I thought was interesting about that was, if you actually were to listen to Warren Buffett's Berkshire Hathaway presentation, I think it was from 1997 or 1998, back when he actually made a significant investment in silver, he kind of talked about this sort of dynamic in terms of where he thought the equilibrium price needed to be to kind of have a market that could actually sustain itself. And I found it really insightful. So I'd, encourage everyone to go listen to that, because he really gives great insight into why he believed at the time that silver prices needed to be significantly higher. And I guess my question is related to Buffett. He took a significant, sizable position back in silver. I think it was 130 or 40 million ounces. And I guess what would happen if a large whale like Buffett or several large hedge funds wanted to take that sort of sizable investment in silver? Would they buy futures contracts and stand for delivery? Or, how would they acquire that much silver? Would they actually acquire it through paper contracts, or would they actually try to get the physical investment?
In answer to the man's question, the way Warren Buffett did it is he actually exercised some out-of-the-money calls on expiration back then, and he ended up getting futures contracts. When you exercise a call, they get exercised into a futures contract, and then it's my understanding that he started taking delivery of those futures contracts, but he started with out-of-the-money call options. They weren't in the money at expiration. He called his broker and he says, what the heck, exercise them. And it really caught a lot of the traders by surprise at the end of that day, because all of a sudden now you had out of the money call options requesting futures contracts, and the guys that were short those futures contracts didn't think that was going to happen.
And the one thing, Jim, that was appreciate your insight on that. One thing I would add is this is actually how I see it playing out. It's going to be large players, and those large it doesn't have to be a Warren Buffett, but it's those large players, the institutions, coming to the understanding that the kicking the can down the road is going to be becoming increasingly difficult to do that with paper money, with debt. And so they're going to start to move into, and this is probably going to be on this is going to be on the ETFs, whether all the metals there or not. That's a subject for another debate. They'll probably try to take physical delivery, but the cheapest way for institutions to do that is, there's other ways to do it too, but it's going to be a combination of both. But you're going to see them move more into the ETFs, probably take delivery of physical, maybe through the futures exchange. But this is the dynamic that will actually start pushing the price up. And the one thing I disagree with Philip Newman is this energy cliff issue that we're going to be dealing with. It's not where when the silver price goes up to 50 or 100, okay, I need to sell and get dollars. What on earth are you going to do with dollars? They're going to get the dollars are going to get even in worse shape of paper money. And so you only sell silver if you're going to buy something that you need. So you shouldn't trade silver for dollars in the future, even though you could see high prices. So I think the revaluation of the metals, especially silver, I think it's going to happen as more institutions wake up to the problems we're having with energy and how it's negatively impacting the value of all these assets that they're supposed to be in. What is a balanced portfolio? It's stocks, it's bonds, and it's real estate. Well, those three things are going to get into a lot of trouble. And so that's when you're going to see these large players start moving in. And I don't think it's going to really matter. It's going to come from everywhere in time. That's how I see it playing out.
In defense of what Steve is saying, guys and gals, the small money, the small traders, the independents, the speculators, the small guys, the 1, 2, 3, 5 contract players, they don't really have a chance of moving the market much. They might get stopped out or stopped in mass, and that can provide more pressure on the downside or more pressure on the upside. But Steve is exactly right. It's institutions or a billion banks or funds that move the market with their flows.
A certain aspect that a lot of people don't mention is when Buffett bought all that silver in 1997, he caused the lease rate of silver to blow out to about, I think it was 80% for the 1 and 3 month, if I'm not mistaken. So he agreed to roll over most of his silver and wait for delivery. And in the meantime, he leased out his own silver and got a great return.
Good Life, you said you had another question, right?
Yeah. So one of the other things that I kind of think about is, obviously silver isn't the only metal that's mined out of the ground. There's obviously base metals, in oil and gas is mined out of the ground. But obviously silver seems to have the worst returns from the standpoint of investment returns if you look at the miners that mine primary silver mines. And so I guess what I'm trying to understand is, like, how can you have someone that essentially operates the same way in terms of extracting metals from the ground, like a Freeport McMoran or something like that, have a significantly better return profile than primary silver miner? In my mind, it just doesn't add up unless there's other forces at play that are suppressing price of silver. And that kind of goes back to, my equilibrium price of what it would need to be to actually have a sustainable market for mining silver out of the ground. And so I don't know if it's a question or if it's more, how do these larger miners, whether it be Rio Tinto, how do they generate great returns for their investors, while at the same time silver miners are negative returns every year, pretty much?
That's a good question. We tend to look at the silver market with blinders on. And I'm guilty of doing that because I did a video on my YouTube channel talking about the manipulation of silver, and I brought up the natural gas market in the United States. If you think the primary silver miners have been struggling, the largest natural gas producer in the U.S., Chesapeake, went bankrupt a year ago. Bankrupt. And so when you understand such an important energy source, natural gas, the price of natural gas was averaging about $6 to $8 prior to 2008 in the United States. It would go up to $12, $14. Once shale gas came on, it fell and it was averaging between 2 and 4. It decimated the shale gas industry, decimated them. So you could say there was manipulation. You had bankers in there. No, sometimes it's just crazy the way the markets work. So you had the largest natural gas producer in the U.S. go bankrupt. They've come out of bankruptcy and they're still producing the most natural gas now. And they're really not making a lot of money. The issue is that gas is gone and burned. But guess what? The silver coins that we bar, they're not. That's why silver and gold are money. And so I think the issue we need to understand is this. The bigger base metal producers and even the bigger gold miners are pumping out a huge amount. So it's economies of scale. A lot of primary silver miners, most of them, 5 million, 10 million, 12 million, 20 million. You look at the revenues compared to Rio Tinto or Val or, it's economies of scale. And that's what it comes down to. And so that's why they tend to be more profitable. And they're also in jurisdictions around the world where they're taking advantage of the foreign countries. And so I think that's probably an aspect that is underappreciated. But unfortunately, I think the primary silver miners, if we still see lower prices, it's really going to start to hurt the primary miners. I think if we see the same prices here for the next quarter or two and energy prices don't go down, you will start to see companies mothball some of their higher cost mines. They don't shut down completely because they could lose a buck or two an ounce, and they'll just have to get a little bit more debt. But if they have a mine that let's say their all-in sustaining cost, according to their data, is 22 or 24, they'll shut that mine down. And so you'll see less production coming in that way. But it won't be a lot in the beginning. So I hope that answered your question.
Yeah.
Anastasia, you had a question. Go ahead.
Yeah, hi. I have a few questions because you guys are so knowledgeable in so many areas. And I'm just a psychologist that doesn't really know a lot about this stuff, but I've been learning over the years. But now we're in a very different scenario than we've been in the past because we have this global World Economic Forum pushing us out of the energy sector, away from oil, gas, fossil fuels, and trying to get us into this green thing, which is failing terribly. They're just experimenting on people, on humanity, with everything, trying to figure out how to control us, how to take over countries, blend countries together, take away their sovereignty. So there's questions now of, first I thought the fall of the Fed, the fiat, the bankers was going to be a good thing. But now it seems like it's a purposeful takedown of fiat currency to move into this digital currency, which is scary as well because they want to track us with that central bank digital currency. So everybody's wondering, what do I do with my fiat currency? So it's sitting in my bank because the stock market's tanking. Yes, I could buy metals, but I can't really use them to buy anything with. And I'm storing them, and some of them are 100-ounce bars. And there's really nowhere else to put your money. So there's a lot of confusion about what to do with this paper money that's losing its value. And are we going to be on this digital currency? And how do we avoid getting onto this digital currency? Because they can track what we're buying and tell us what we should buy and what we shouldn't buy. And there's a lot of fear out there. So I also have a second question. So this particular question is what to do with your money, the last one. The other question is, I have a car. It's a gas car. It's an Audi 2017. It's got low mileage. I've asked in another space if I should keep it because I bought it after the lease, because I'm worried that my car is going to be worthless in a few years when there's no gas to power it. They might want it for contents of it, the silver and maybe something else in the car, or the chips. I don't know. But I'm just worried if I keep it, I'll be able to trade it in or sell it in a few years. But I've had another couple of people tell me, or in the used car business, to keep it, that this isn't going to happen for a long time. I'm done. Those are all my comments and my questions. Thank you.
You know, you brought up a very good term, psychology, and that's all the markets are. It's all it is psychology. And the psychology right now is we're on the Titanic and we're having lots of fun, even though we're going through some storms. When I'm talking about the problems with energy, that's the iceberg. So just think of the psychology of the wealthy and the people on the Titanic playing music, having a good time. They have no idea what's coming. And so they have a psychology, and let's say we fast forward to today, and it's a modern Titanic. They're on their cell phones, they're trading, they're all trading the same crap, all the same stuff, the stocks, bonds, all that stuff. But we haven't hit the iceberg. We're hitting the iceberg, but it's slow at first. So once the psychology changes, that's when we start to see a revaluation of the metals. And the reason why is because they store value. Because when you move into a future of energy scarcity, you can't build wealth. You have to protect it. And you can't protect it in these assets that are going to continue to lose wealth. So that's the one thing I wanted to talk to you to answer your question. And so even if the central banks go to digital currencies, and they probably will, because the problem the Fed had and the government had when they issued all this money, let's say they issued all this money to Americans. It wasn't printed, it was borrowed. They actually borrowed it from foreigners. The M2 money supply went up because we borrowed these trillions of dollars from foreigners. It came into our monetary system. We took that borrowed money and we could send checks to Americans. Well, the digital bank system, the currencies, would allow the Fed to issue money directly in your account without having to go to the Treasury and issue debt. That's very inflationary. And that's when you should really own the metals. And so some would say, well, what if they kibosh the metals and they say you shouldn't have metals? Well, they'll probably, if the worst comes to worst, I don't see them doing that, but they'll still give you money for your metals. And they're not going to give you like 10%. They'll give you market value. The problem is, even if they go to digital currencies, the problems we're going to have with the grid coming, it's going to be very hard to maintain a very high-tech global or regional currency, a digital currency. And so I think even if they do that, they're going to have major problems with it. It's still years away. But I think the energy problems that are coming are going to make that solution much worse. And then your last question, other people can talk. We're starting to see big problems with green energy. I mentioned this in one of my Twitter spaces. The last German wind turbine plant shut down, Nordex. They shut it down last month. They also shut down their wind blade plant because the prices are so high. Energy prices are so high. It's impossible to make wind turbines and blades in Europe because the prices are so high. And now we're seeing this.
They're also hideous and they kill birds. And also, I was reading something about when you dispose of them, it's very toxic to the environment, as well as the car batteries, electric batteries.
You're absolutely right. And so the issue is here's my footnote. I believe we have in climate change, but green energy doesn't fix it. It just makes it worse. It was a bad solution. It's like if someone's drunk, well, what they've decided to do is to give them a half a bottle instead of a full bottle. And so that didn't help them. That didn't help the situation. And so I don't think you're going to have issues with your gasoline car, because I see in the next few years, I think as we're seeing now, Europe, Germany is starting to do more coal burning. Switzerland has just put on a nuclear power plant. They're restarting an old nuclear power plant. Japan is going to restart half a dozen nuclear power plants. The green energy is going to get much more trouble because the prices to produce green energy now with energy costs so high are prohibitive. So we're going to see gasoline cars for quite a while. I think EVs are going to get into much bigger trouble. So I don't think you should worry about your gasoline car.
And to your point, Steve, it's I spoke with David Hay today, did an interview with him this morning, and him and I spoke about greenflation, as he has coined the term, as well as the idea that this is the first time in history that we've ever transitioned a less efficient way of producing energy.
No, that's perfect, Tom. I look forward to listening to that because that's exactly what it is. It's I'll let the other speaker talk.
Hey, so sorry about that. My question was really about hedging, because I actually work at a bank and I've hedged interest rates before. And one of the things, the dynamics that happens with hedging and interest rate positioning is when we get near zero rates, any bank that is asset sensitive takes off any hedges that would protect them from falling rates. And my question is really, a lot of silver production, I've heard 60, 70, even a little higher than that, is secondary metal. So my first question is, do players like a BHP or Rio Tinto hedge their byproduct metal like silver? And secondly, if prices fall enough, do they actually do kind of like what banks do and they say, well, there's not as much of a point in hedging anymore, so we'll actually take some of our shorts off, because obviously they're, the reason they hedge is they're worried about a fall in prices. So those are kind of my two questions.
Can I help a little with that?
Yes.
Go ahead, Jim.
Okay. It's my opinion that the metals mining companies hedged implicitly back in the 1990s. And they lost a lot of money when we had a big run-up in the price of the metals. If you can imagine, if you're familiar with hedging interest rates using T-bonds or 10-year notes, a hedge is okay when it's working for you, protecting against adverse price movement. But when it goes the way that you want it to go, meaning you want metals to go higher, the hedge costs you money. So they lost billions of dollars, is the opinion that I have, a couple of decades back. That kind of brought into the realm of contractual obligations with bullion banks, where they can call a bullion bank and they can say, I've got, let's say, 10 million ounces. The bullion bank says done at an agreed upon price. They wire them the money, and the bullion bank owns the silver or owns the gold. The gold and the silver, they go to a refinery. It gets refined into delivery grade in terms of 999 silver or 999 gold, and gets poured into delivery spec market gold or delivery spec silver, which is 1,000-ounce bars for silver and 100-ounce bars for gold. So the hedging has effectively been taken away from the mines, from the big mines that you're talking about. Not saying that they don't have a hedging desk that might do some, but the majority is a fixed contractual relationship with a bullion bank.
Got it. Okay, thank you. All right. If anyone else has any other information on the hedging, I'd be curious to know. I'm almost to the point where I want to go work at one of these big miners hedging desks and just see how it all works. But it's another story. Thanks.
Steve, did you have anything to add there?
Yeah, one of the larger byproduct producers is KGHM Palisades, and they're out of Poland. And so they produce upwards of 40 million ounces of silver a year. So if you go to their website, they have an English version. You can check out, and they have had some significant hedging on silver because it's such a large percentage or a large amount. I mean, 40 million ounces in a year, they're one of the top producers in the world. So they have a vested interest to hedge, and they tend to hedge more when the prices are higher. And then they tend to reduce their hedge book when prices are getting down where they are now. And so you should check them out. But I agree with Jim. The larger metals have the contractual obligations too, but it's less of a supply than their overall whatever their base metals or iron, some of these huge metal producers. So I think KGHM Palisades out of Poland would be a good place for you to check out their hedging strategy.
I will do that. And what is the metal they're primarily mining, or is it just a lot of base metals?
No, it's copper. They've been producing copper there since the Roman ages, and so a lot of copper comes out of Poland. But there's a lot of byproduct of silver, and we've had that in some other mines throughout the world. A lot of times you see zinc and lead, especially in Idaho and Colorado, and even Mexico. We find in even Australia, Cannington, which was one of the largest silver producers about 20 years ago. They were producing 45, 48 million ounces of silver. They're big, a lot of zinc and lead, but they produce a lot of copper in Poland.
Okay, thank you very much for that insight.
Tom, we had some discussions, and you see, the thing is, everybody has their opinion, and I respect opinions, but we have to always go back to the data, because I can tell you my beliefs till the cows come home. Oh, this is what I think. This is what I believe. This is what I feel. But I always look at the data. The data tells me what's going on, not me telling the data. And if we look at Caterpillar, if you're a mining company, everyone in the mining industry has got Caterpillar on their quick dial because they use Caterpillar equipment. Other mining companies. And if you look at Caterpillar, their CEO says they're still dealing with supply chain issues. Matter of fact, they could not produce enough of their equipment, their mining equipment, their construction equipment, due to problems with the supply chain, and it's still going on. And we haven't even gone down the energy cliff yet. We haven't even started going down in oil production, because I don't care how efficient you become. There's less oil flowing in the world. There's just going to be less production of different materials like cyanide to produce gold. There's just less production of goods and services. And that's we saw this. We played this record over and over and over and over in history. If you open a history book, people say, Steve, well, we're going to be fine. We're going to add more energy. We're going to become more efficient. We're going to use more technology. And I disagree, because technology actually makes it worse. And if you look in history, every civilization and empire has collapsed. We just want to forget history. And we think we're better because we've got all this nifty technology, but only technology just consumes a massive amount of energy. That's all it does. It isn't more efficient. And so I think we'll know. You don't have to believe me. Well, if we just wait around some years and see this energy problem start to really happen, we will see the breakdown in the global supply chain get worse and worse. So I think time will show the evidence. I've said I could get the timing off, but I'm basing that on the U.S. shale industry and of U.S. shale production. Every year, we lose a percentage of shale production every year. It's 4 million barrels a day. We lose that every year from the shale industry. We have to replace that. A lot of capital expenditures. And we're running out of drilling locations. So if the growth in the world has come from shale, and it depletes at almost 50% a year, that can't go on forever. So I'm not going to do any bets. I could be a little wrong on the timing, but if you look at 1,000, 2,000 year chart of the world population, and then you look at what's happened since oil came on the picture, our population has gone straight up. And I call it exponential. Nothing continues that way. So, this is common sense, really. And again, you look at the Roman Empire, look at the Mayan Empire, you look at all these empires, they all went through the same cycle. We just want to forget history. It's convenient to forget it when the times are good. So I just want to, that's how I can answer your question.
Simon tweets, if you want to ask a question.
Well, I first want to explain the point. SRSrocco said that when you have such an intertwined world, also with petrochemistry and all these kinds of things, that's very easy to forget. His energy fairy eyes completely sign into. But on the other part, which I don't know if it's the right room for the question, is what will happen politically when you see like a winter for energy and ducks fighting over fewer bread. Let's put it that way. Will we get that kind of world? How you think this less energy, and it's so important for every economy. So there's lots of stuff at stake. What will happen to geopolitics? Can you say something about it?
That could be a subject for a whole another Twitter Spaces, and maybe we should talk about that. But in a nutshell, in the summary is, if you look back in history, Lucius Seneca, about the Seneca Cliff, he was an ancient Roman philosopher, said the way growth is slow but sluggish, but the way to ruin is rapid, especially when you throw technology in there, because everything happens so much quicker. And so humans can only cut down so many trees and make charcoal to smelt metals back in the ancient Roman Empire, but we can produce 100 million barrels of oil a day, and you can do a lot of stuff with that. And so I think the issue is, I believe the central banks, even though we can criticize them, even though there's side effects, what they're trying to do is they're trying to keep the lights on for as many people as possible. That's what they're doing. And one of the side effects is some people get much wealthier. But guess what? When we go down the energy cliff, those wealthy people are going to get wiped out. And this happened in the late Bronze Age. The wealthy, the elite during the late Bronze Age, 1300 BC, they got wiped out. And so the idea that the elite are just going to take over the world, no, they're much more vulnerable because they control all this stuff.
That's my point. I don't want to discuss, the WEF kind of thing. I just want to say, if you need energy for your economy and you want to secure it, then, maybe a bit like how kings of old ended robbing another country to get the treasure chest. And how is that with energy? Without talking about the elites, and all that I think from the country perspective, it has only three main objectives at the bare minimum. One is to control the money, second to control the army, and third to have access to energy resources. Because without access to energy resources, you have no economy, you have no money, and you have certainly no army to move out. So if you have a big, huge army, you need lots of oil, it means nothing when it goes off a cliff. So it's very geopolitical. So it means how you will fight war, but it will also, could also be that it's a reason to invade a country to get these resources. So that's my question more primary, not the web thing. That's another story, I think, too.
Well, I agree with you. And in a nutshell, we're going to see more of that. We're going to see the world leaders, the world regions competing over the remaining scraps of oil, of energy. And those who hold the energy cards, and I've said this, it used to be those who held the debt and the money. Those are the ones that were in control. The U.S. has been in control because it's the reserve currency, the dollar. But we're also a major energy producer due to shale. And we're exporting natural gas, some coal, even petroleum products. But those who control the energy cards are going to be the main winners in the future, or they're going to survive better. So as this thing kind of rolls over and plays out, there's going to be more resource wars and there are going to be more competitions for this. But I'm not quite sure how that plays out. It's going to be very volatile, but I believe those you see, Russia is, I hate to say this, Russia is in a much better situation because they only consume between 30 to 40% of the energy that they produce. They export the rest of it, oil and natural gas, and even coal. Whereas Europe imports so much natural gas just to stay alive. And so that's a big problem. So this just gets worse as we roll over the energy cliff. And those who import the most energy, like Turkey, why do you think they're in trouble? They import 96% of the natural gas. That's why they're in trouble with their lira, their Turkish lira. The currencies that have the most dependent on energy imports are going to be in more trouble than those who are net exporters. And that's how I see this dynamic playing out, even as there's going to be more resource wars.
Thank you so much. I hope we can speak in another room at another time, but thank you so much for all your answers, sir.
Thanks for the pleasure. Let me to share some of this information. And that's what we do at the SRSrocco report. I think it's important, if I am correct about the energy cliff problems, we'll know that we're approaching it if the inventories in the world, the oil inventories in different regions, the U.S. and Europe and in Asia, and the natural gas inventories, if they continue to trend lower, because that's the buffer. While we have bank accounts to get us through hard times, savings accounts, the world has energy inventories. And if those continue to decline, the bank account of that declines further and further, we're going to see huge volatility in the energy price. And that's very bad news for a highly leveraged debt-based economy. So I just wanted to finish up on that last thought.
I 100% agree with that. 100%.
You organizing Philip to come on today. And of course, your contribution as well. It's always kind of sobering to hear about the energy side of the equation and how important it really is. Thanks to everybody for tuning in. Thanks, Jim, for your input. And we'll see you guys on the next Spaces.
Thanks a lot, Tom. And thank you, everybody, for participating and listening.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.